course, it's 8 o'clock, and we've just been chatting about this buy trade at the bottom edge just as we stepped into the room this afternoon or this evening. And there was a nice buy trade setting up, and we did suggest that there was a nice sweep about to take place into the bottom edges here. And if you were in the room at that point, you would have heard me live mentioning the trade opportunity. And it's obviously an interesting opportunity because it's involving one of the important elements of trading, and that is the idea that there is a big decision getting made here at this point on the screens. Now, obviously, the big decision has got nothing to do with whether the trend line's broken or whether the stochastics in play or not. The decision is about whether there's any value for the big commercials to buy this or sell this. And that's not about where it is on the chart. It's about what is going on in the background, the engine room of these markets. So when we started to see that trade setting up, I shouted if anybody was in, they would be able to verify exactly what I said. I said the bottom edge is a lot more constructive. So what I'm expecting, because of the idea of the RGL just here, RGL being the big decision that's being made at this point, I said that based on that big decision that's being made, the chances are they're going to sweep this price lower to take it higher. And that is exactly what they did. They swept the price down to take the price up for that initial first phase. Now, just because there's a buy at the bottom edge doesn't mean it's going to stay a buy going forward. There's always the chance, of course, that the market may change its mind during the formation of that low price. New orders could be filtering through that changes everything. A soundbite could come through from a Fed member or from something geopolitically, from Ukraine or from China or from Elon Musk, perhaps. And then the market could spiral off in an opposite direction. That's just new information. But this is what reality of trading is. It's about dealing with those impossibles and trying to factor them into our thoughts, and then trying in the meantime to just trade what we know. We touched on this morning in Classroom in the US session, of course, when we talked about bond trading. We know what's normal 90% of the time, and we know what's not normal 10% of the time. Not normal doesn't mean we know what to do at that stage. We know what we want to do, but we have to verify how and why we can define whether it's normal or not normal. The normality of the markets is perhaps lost on a lot of people. And we look back at people like the turtles, and they were involved in the markets in a time when, of course, the volatility was extraordinary. And because they were involved in a market time when it was extraordinary, then breakout trading was a given. You simply just made money nearly always. As soon as the market broke out, the size of moves were such that they offset any type of losing spaces where we obviously had the markets just churning around a little bit. So the turtles made a fortune. A legend was born. Unfortunately, that legend was based on a market model that did not exist a few years later. When the market started to rotate a lot more, the turtles started to lose all the money plus more. Just about every turtle breakout type strategy was then blown up in the market mayhem that followed. The market's going quiet, the market's going flat. The same is true of interest rates, of course. We know that the market moves in interest rate cycles, but one of those cycles, of course, is not always from rising to falling. There's a big chunk of cycle that says that the interest rate isn't moving and it stays at 0 or it stays at 5, or the current interest rate climate, it might stop at 15 eventually, God forbid. But the idea is it could stop for years. Well, if you're constantly trading bond concession phases for the interest rate cycle to keep moving, then of course the idea there is it needs to keep moving for you to make money. And if you've not got the ability to adapt to the changing market conditions, this is why retail traders fall apart. They find a system that's obviously back tested in a certain market environment, like it's high volatility. So if it's high volatility, something like a moving average crossover, for example, makes money. But what happens to the moving average crossover when the market goes sideways? The system loses a fortune. And then somebody says, well, what about a stochastic system then? If the market's moving sideways, I'm going to chop into a stochastic system, because in a sideways market, stochastics will make me a lot of money. And the stochastic system starts making money and you're proven right until, of course, the market starts to move back into a trend and you start losing all the money you've just made and you end up no further forward. In fact, you end up slightly behind again, and you say, damn it, I'm going to move back into my moving average crossover system because the market's now trending. Unfortunately, you see the trend in hindsight, and therefore you're late to the party, and therefore you're probably not going to make any money either. In other words, you're always lagging. You, as a trader, are always lagging the story. So what if you could avoid lagging the story? What if you could actually be in early to the story? What if you could be part of the story? Well, we were talking a little bit about wheat before I stepped into the room just there, but well, not before I stepped in, that would be impossible. But I was talking about wheat when I stepped into the room. And I showed this little chart here. And we talk about the idea of recognizing this as a commercial buy trade simply by the green bar that shows up in real time on that screen. This is a 30-minute wheat chart. We actually talked about this in the classroom at the time, and we suggested that this is a commercial buy on wheat. Because it's a commercial buy on wheat, we know that this is a passive buy as the price drops. Well, that passive buy on wheat would mean that if you're trying to trade this aggressively, then of course you're probably losing a fortune. But because we know how to trade this properly, we simply wait for the breaks to the downside. We wait for these aggregation candles, the big volume candles, the absorption candles. And we know this is a long haul trade. We know we're going to be in this for a while. This is a 30-minute chart. It's not a scalp. And you might be saying, what's this got to do with scalping? Nothing. It's just to prove the point. That wheat trade, which started on the 14th of June, was in the market for $6,000 rally until we got this sell trigger on the 22nd of June. It doesn't matter whether this is a 1-minute chart or an hour chart. The point is, we know what we're supposed to be doing here. We know how to handle this exceptional change. And then when this market goes again into this sell trade, you can see the big red sell bar. We're now sell side wheat. We showed that trade trigger, in fact, on the screens. And if you wonder whether this is real time, of course it is real time. It's a trade trigger. It's a trigger that we're now looking at. And obviously we're looking for that short sell to show up. Now, obviously, if you're in a trade log narrative, which we haven't got out yet, then of course you'd see that real time. But obviously, if you haven't got the trade log, then you're going to have to wait for the signal to be tweeted. And that's what we got just here. You'll see the tweet coming out. Wheat finally came to an end with a 120-point winner. And you'll see the red bar there, and you'll see the date, 22nd of June, 10 past 10 in the morning, London time, 10 past 10 on the 22nd of June. And you can see that that red bar is there. So obviously now we can start working short sells, can't we? And where are we going to work short sells? We're going to work into the top edge of the short sell. And as you can see, as we work into the top edge of the short sell, and you can see that that's after the tweet was sent out by 3 days, then of course you can see that coming off that 77 level, big wholesale, big handle, 77 handle there, you can see it's dropped down to the 735 for 35 points. 35 points happens to be another $1,500 plus a bit of change for anybody that shorted the wheat into those high prices like a commercial. So obviously this is not about wheat, it's not about gold, it's not about oil, it's not really about the S&P, but of course it is. It's about trading. It's about the ability to understand what trading is. You get fed so much crap over the decades. In the last 20 years or so, you've been fed all sorts of rubbish, all sorts of stories, all sorts of narratives, all sorts of indicators, all sorts of things happening in the background that you look at and say, it sounds plausible. And when you buy it, of course, it doesn't work. The track record looks brilliant on a back test, but on a forward test, it seems to fall apart because it's back tested in a certain model environment. As this week progresses, we're going to be talking about these model environments going forward. We're going to be talking about things like the Nash equilibrium for anybody that's involved or has ever been involved in things like game theory. So this takes me to a little quick slideshow before we get into the charts proper. And a little quick slideshow. It's not a salesy slideshow, so don't worry. Don't start panicking anytime soon. It's not going to get you worried too much about it. So let's just get started. And this is the slideshow right here. So scalping with game theory, which is going to be the point of these evening classes for this week. Scalping with game theory, looking at the idea and why or what we should be looking for in the overall view of the markets going forward as well, not just the scalping side, but using the same idea of scalping as we move forward into trading. Any market, on any time frame. A lot of people say, do you do short-term trading or do you do long-term trading? What? I don't understand that question. I've never understood that question. To trade long-term, you trade exactly the same way as to trade short-term. It's just a different time frame of reference. It's just a short time frame difference. So we understand that there's a difference of approach at that point, don't we? So when we look at this idea of scalping with game theory, it took me seconds to put this slide projection together, guys. Come on. Look at it. It's going to even get graphics and a dice on it. What the hell? So when we move forward with this as a basic idea, the idea is very, very straightforward. Do you know how the market makers play? This is obviously really for anybody that's new coming in. Do you know how the market makers play? Do you know how the commercials and the prop and the algos play? So obviously these are the main players in the background of the market. The main players in the background of the market are the big market makers, of course, the commercials, the prop desks, and the momentum algorithms that make up a lot of volume. But do you know how they play? Because ultimately in any game theory, the idea is that you've got to know the rules of the operators. You've got to know the strategies, the best strategies of the operators in play. So today's classroom will be looking at those basic strategies initially to get an idea of how the commercials, specifically the market makers, actually operate. If you don't know how these players play, then do you know how to use their strategies inside a game theory framework to analyze probability outcomes that will then reveal probabilities for possible trade strategies? It's all right coming up with a probability, but you've still got to come up with a trade idea about how to make money from it, how to monetize that knowledge. So if you don't know how the market works, you shouldn't be in the market, right? Imagine turning up at a game and they say, right, tonight's card game is contract bridge, and we're going to pay $1,000 buy-in. So everybody pays 1,000. Whoever wins, the team wins, they get to collect the total sum of money at the end of it. But you've no idea what the rules are for contract bridge. You got any chance of winning, guys? So one guy says 2-0 Trump, and you go in and say 10 spades. You're like, what? What do you mean 10 spades? 10 spades seems like a good bet. Well, obviously you're going to get annihilated, aren't you? You're going to miss your target price by a mile. You're going to lose all your money immediately because you don't know the rules of engagement. So in every single game theory situation, it's critical that you know the strategies employed by the big operators. Otherwise, you're going to be simply in the background getting busted every time you try and trade. Their job is to get liquidity. And if you happen to be the diddy that provides the liquidity, then so be it. Brilliant. But that's something you've got to recognize. When you take part in the game, you've got to know the game players. You've got to know who's doing what. And if you don't know that, you shouldn't be live trading, that's for sure, until you learn these processes. So when we think about things like equity scenarios, we've got a couple of examples of things that we've talked about live. And then we've got outcomes about what happened next. You'll see that the message is all time-stamped, so you know that it's live messaging. It's not hindsight stuff, it's live stuff that we're talking about. And you can see here, equity scenario on the, this is just before the cash open, on the 22nd of June. This is London time, by the way, in case you're wondering, that's not the cash open. Of course, this is just before the cash open at 2:30 London time. So this is 12 minutes before the cash open on the 22nd of June. Equity scenario, with the option exit seen and rising gamma line, we didn't see any buying into the close, suggesting that hedgers were holding short equity positions through the Bank of England today. This is the day, you might remember, was the Bank of England day. This was the day the Bank of England did a surprise 50 basis points, remember? So what? So watch for evidence of bids into delta selling for a developing bottom line. Now, bearing in mind the timing of this, we're talking about the cash open. So we're talking about watching for bids at the cash open because we're going to be buying this at the cash open, right? Well, you can see what happened. You might be saying, but why were you thinking about buying it? Well, if you look in the charts here, you'll see that we've got what we call the dealer skew. And if you look at the dealer skew here, the dealer skew is 13/11. So with the dealer skew at 13/11, that tells me that the dealers are expecting this day to be positive, even though we had a Bank of England surprise 50 basis point hike. So coming into the US Open, I am a buyer. I've already got my idea. I've already tweeted my idea so that you know that it's happening in advance and it's not happening in hindsight, which is great news because that means it's actionable on the right-hand edge of the screens. And obviously the idea here is I'm going to be starting to watch for the buy opportunity. Well, you can see what happened to that trade. The S&P literally for the entire day traded higher and we made a lot of money. Knowledge is worth cash in the case of the markets, isn't it? So one of the things that we understand about these types of ideas is, so what? Well, when we look at something like this, you might be saying, what is this? I don't know what this is. It's an oil chart. It's an oil chart that shows relative value. If I said to you that there's a couple of very, very important elements on this screen, you might be saying, okay, what are they? Well, number one, there's the background color to this chart. The background color is red. That means that as a local on the floor of the exchanges, they would look up at the big board and they would see red numbers. One of the most important, single most important features that you'll ever see as a local going forward. The market's red, I would rather be short selling. The market's green, I would rather be buying long. So with the market red, I am now favoring the short sell. The second rule, of course, is the concept of benchmarking. If I'm going to benchmark this, I want to try and find areas where the black line is trading at a premium to the rest of the lines. Straightforward. Does everybody know what we mean by the black line is trading at a premium? In other words, the black line's going in the opposite direction to the rest of the lines. Now, obviously, the black line should be rallying against all the other lines if I'm short selling this market, not falling. So therefore, if you can see these opportunities, if you can look at that chart and spot a solid three areas where the black line is not doing what the other lines are doing, then you would be able to make money today. You'd be able to make money off that screen. So if you can spot three areas where that black line diverges, you would be able to make money. Let's take a look and see what happens to this as a storyline. Can everybody agree that those three areas are unique amongst all the areas that they go in completely the opposite direction to all the other lines? Yeah, they go completely the opposite direction to all the other lines. Now, obviously, it's up to you to agree or disagree. It's up to you. It doesn't make any difference to me whether you agree or disagree. I mean, they are going in the opposite direction. You might argue that the black line was kind of starting to show up on this little candle here at first. Okay, yeah, so we'd have two black lines here, but rather than draw two in, we would only be drawing one in. So the idea is if you could spot those in advance. Now, obviously, if we go back that trade to the previous narrative there, if you can see them on that chart now, you can make money as an oil trader. If that's all you can see, if you can spot those black lines in a red market as an oil trader, you can already start making money, literally with that one piece of knowledge. So let's see how these trades developed. So if you can now look at that chart and see where those areas are, recognize that the black line is going in the opposite direction from all the other lines, and they are unique in those locations. In other words, we're not just cherry picking examples here. By the way, I think this is yesterday's chart. It's just because when I put the screenshot together, I didn't want to go back 5 years to find one example, right? I think this is yesterday's 5-minute chart. There's a few dozen opportunities to do trades here. If you can spot those trades, let's take a look at how you would have been able to perform on a tick basis on those trades. Let's take a look. So these are the trades we've just highlighted. The same black lines, if you look at the time of the day, you'll see it's Friday the 23rd of June. Friday the 23rd. If you took those trades on those black lines, that would have been your trades. You'll see that this sell trade here lost 5 ticks and made 28 maximum. This sell trade lost a maximum of 8 ticks, made 21 ticks maximum, and these are maximums. These aren't what you would have achieved. This is the maximum profit that these trades made. And obviously this trade here had no drawdown at all. You were selling at the close of that candle, and of course, it never had any drawdown, 0, and you would have made 45 ticks maximum on that swing. So obviously, if you total up the maximums, we get 94 ticks maximum profit. 94 ticks maximum profit, a pretty good day's trading. Well, it's not really a day, is it? It's really about 2 hours in the London session. 2 hours in the London session. And that's working short selling in a short selling market when the big board is red, when the background is red, when the big board is red. And all you have to do is find those benchmarks. You just have to find those benchmarks each day, verify them with a few other checks and balances, and then recognize the opportunity. Now, oil's one of the best markets for that, but obviously the same thing is true of things like gold. If you can look at that gold chart and recognize where the gold line, now we've taken away the background coloring to this, but if you can recognize where the gold line diverges aggressively from the red line as a benchmark starting point, at the same time as diverging from the red line, I want to make sure it's also starting to diverge again from the green line. I've got to be careful we don't have some of the other drivers acting against us on these trades. But if you can see the gold line diverging from the main ribbon of these lines, if you can spot the gold line where it diverges here, you can make money as a gold trader as well. Let's take a look at, see if you can see and agree with the arrows and the lines that we've put on the next screen. Can you agree that these areas are quite clearly diverging from the red line? Well, this one had a macro divergence, but the red line's still going up. The red line's still going up in this area here. And we can see that on this trade here, of course, the red line's going down. So that's what we're looking for. So that's going to be definitely an opportunity to deal. The green line is giving me a strong enough suggestion that this is good. And then this trade here, you can see the red line goes flat here. That's the minimum requirement for a sell trade. And that's another line. Fair? That line doesn't count. That line doesn't count. These red lines are going up. So those lines don't count. So this is the only candle that trade is verified, isn't it? The only candle. As we move into the top edge, the red line drops, the gold line rallies. So that's the only candle. And you can see that we don't have anything else during that period. We can see on this orange line here, the red line's dropping, the green line's dropping. So that's confirmed as a signal. You can see here that the orange line rallies, the red line drops, green line drops. That's a signal. You can see here the orange line rallies, the green line's flat, the red line's dropping. So that's a signal. And that's it. That's the only signals, isn't it? That's the only signals that we've got to trade gold. There aren't any other signals. There isn't something in there that you would look at and say, well, I'm definitely this or I'm definitely that. There's other obviously buying opportunities, perhaps. The one that you're probably already staring at is possibly this buy trade here. But obviously that's against this macro narrative on the green line. So that's not a buy trigger for me. It'd be definitely a profit take if I was short at that stage. But it's not a buy trade. So if you agree, that's up to you. If you agree that they're the only trades that are available on that screen, then of course, let's take a look and see how you would have performed. This is a very, very short-term chart. This is a 1 minute chart on gold. 1 minute chart. In other words, it's a scalp chart on gold. So let's take a look at how you would have performed. Now, I'm not doing any funny business with these lines. No point. You can check the times or whatever you like. You can go backwards and forwards 20 times if you need to verify that this is the case. But this is what would have happened on your gold trades based on those exact same lines. They're all short sales, of course, and they're all short term. This had a $10 drawdown, bid offer spread, $70 potential scalp profit. This is a $10 drawdown, a $100 scalp profit maximum. This is a $10 drawdown and a $220 profit. This sell had a $0 drawdown and a $200 profit. This sell had a $0 drawdown and a $190 profit. This sell had a $20 drawdown. Oh my God, 2 ticks drawdown on that one. It still managed to produce $150 maximum swing profits. So when we look at this as an idea, we can see that this is obviously $200, $400, $600, $750, $850, $900 plus a bit of change. $900 profit with a $20 maximum drawdown. And that was over a period of an hour. A period of an hour per contract, of course, maximum over a contract period of an hour. So when we look at this as a storyline, and we look at how this has been brewing in gold, we can recognize yet again the problem that we're facing is being able to look at the right-hand edge of a chart that doesn't have anything on it and try and think, how do I make any sense of this? This is the concept of today's classroom, of course. When we're presented with a chart, this is an S&P chart here, we're presented with a blank space. So what are you going to do? Well, obviously, if we look at prices on that blank space, we're going to start seeing potentially highs and lows. We're going to start seeing big candles and small candles. We're going to be able to check the volumes on these candles. So we start building some ideas on the right-hand edge, don't we? As we move forward from that screen, we start looking at the big board. What color is the big board? So what color is the big board? Well, we can see that the big board is blue. So with the big board blue, we're already starting to get a feeling that today should be trying to find some buy opportunities. Well, obviously, this is Fridays. We should be trying to be buy side, but obviously there's still always that opportunity to start working on the short sell, of course. But we should be trying to be buy side. Well, you might remember that short sell we talked about just as we were coming into the room. Do you remember? We were talking about the short sell. Well, guess what? That short sell kept going. That short sell kept trading. That short sell kept on your books. Take a look at today's market. Here it is here. So we bought the bottom edge when we came into the room here. We've been selling these pink bars at the top edges here, and we've worked down into the bottom edge because we've been running some beautiful sell side liquidity. And that's obviously given us that perfect little short sell on multiple opportunities to work into that top line short. It's traded a low price of 81s, high price of 85s, 4 points, $200. Nice trade, right? Nice trade. We'll obviously come back to that chart as we go forward into today's session. Okay, so buy side only based on the big board. How do we work out what the big board says? Well, see when you look at the pictures of the floor, and you see all the locals on the floor shouting and bawling, and then you look behind the locals on the floor, you'll see the big board behind them. The big board has a color. If the market's trading down today, the color is red. If the market's trading up today, the color is green. The big board. The locals glance at that big board and make sure that they are on the right side of the market if they can possibly be on the right side. They might sometimes still take a fade against that direction, but it's always better to be on the side of the big board. So on top of that narrative there, you might be saying, but now I need to try and put some idea of value onto that screen. We add in some value ideas. Doesn't matter what this is at this stage. We add in a relative value. We add in a second relative value, and we start thinking to ourselves, right, this obviously means something. This idea starts to develop out thought processes. We add a third relative value, and we say, okay, well, what is that? Well, we're going to learn what that is as we go through this week's classroom. We're going to learn what this process builds into in terms of the best opportunities as a signal trade. If I now take that from that narrative there and I come up with another series of signals, which is this series of signals here, you start to recognize what the signal is. The signal is the black line going in basically the opposite direction to the other lines, to the other two lines. The black line going in the opposite direction to the other two lines. Now, you might argue that the one in the middle is going in the same direction as the purple line here. The black line's dropping a lot more, however, and there is a macro context to this, which is not something you should be missing out on. A very large macro context to this. So on a macro chart basis, the purple line is still rising, and obviously in that sense, the orange line is still rising, but the black line is falling. This is a very short-term chart. This is a 15-second chart. So this really is the world of the market scalper. If you can agree with me, and it'd be hard not to be able to agree with me here, if you can agree with me, did anybody see that buy trade, by the way, guys, that was flashing on the right-hand edge of our S&P? Did anybody spot it? Remember, there was a green flash on the right-hand edge of the trade. Yes, no? You might have been able to recognize it. It was flashing on the right-hand side of the charts when we had the screen across earlier. So that buy trade has obviously swept the price higher there from that low price there of 81s, and it's just traded 85s again. So another 4 points. So if you saw that flashing green when I had it on the screen earlier, you'd have been able to think about the possibility at that stage. Just think about the possibility of bidding into that as a narrative and obviously try and grab a little bit of a top line sweep, testing into this prior bracket high perhaps. A little bit disappointing that we never ran the liquidity at the bottom edge. That would have been a far better opportunity to do that, but it never did it. So we can't show you that it did when it didn't. So simply a buy trade running back up to the top side. Now, do these things happen in real time? Yeah, well, of course they do, because we saw this one here. We saw this one here when we were talking about it live, and obviously you've seen these trades coming in. Do they repaint? No, but they do flash on and off during the formation of the candle. And obviously, if the trigger is still valid at the end of the candle, then of course, that's it. It just leaves it on the screens. It's a real-time chart. It's not dependent upon a candle finishing for whatever reason. That's the case. But a great little trade, a nice little scalp profit again from that buy trade on the S&P. Okay, so looking back at this chart, one of the things we're now looking for is this idea of the lines going in the opposite direction. Now, the other thing that we're also going to be interested in is the idea of trying to get liquidity and the idea of trying to make sure the macro lines up with the sell or the buy as well. So obviously, when we're looking at this, the idea that the macro should line up is obviously very, very visible on this middle trigger here. Very visible on the middle trigger here. So we can recognize the value narrative that is very strong at that stage. Now, obviously, there was a tiny little dip here, for example. Well, the macro in that is completely really against that trade at that stage. Now, obviously, if we were to run the stops, I might be interested in this one. You can see the macro and the orange line is flat, however, if not slightly dropping. So in terms of the value in that, I don't like the trade at all. I don't think we've got any value. So there still has to be, it's not an automated process, is it? There's a chart process, a chart time, but there's also a background time to each of these trades. There's a background reference to each of these trades that we should also make sure we take into consideration. If we understand that, we can use charts, we can use triggers a lot more accurately. So let's take a look and see whether any of those trades would have been developing into a buy or a sell opportunity. If we take those trades on their own, then of course, in isolation, we can see that those trades would have generated a fairly decent profit into those trade areas if we just took those trades. With a drawdown of 0, we could have made a maximum of $100. Now, bearing in mind this is a 15-second chart, it's a very fast scalp chart. This was the best trade by a mile. The drawdown during that period was 12.5 bucks or 1 tick. And of course, the upside was about $125 on the straight line drive. If we took this buy trade in here, the drawdown was 0. It was already bidding up. And obviously into that trade made a maximum swing of about 75 bucks. It's a scalp trade after all. It's not a swing trade. So we can see that these scalp trades in the right environment, in the right location, doing the right things with some additional ideas thrown into suit allows us to find the best possible trades in that macro landscape with the micro narrative agreeing. So this is why we're not a victim of simply a divergent line. We're also looking for some of these other elements. So what are you going to learn in this whole 5-day period? What are you going to learn to read when you start looking at these charts going forward? Well, we're going to be learning credit spreads. We're going to be learning all about the volatility structure. Why is that important? Why is it important that we learn about credit spreads? Well, because credit spreads are one of the big risk metrics that we look at in this trade. And if we're looking at the risk metric that we're looking at in this trade, we can obviously understand that credit spreads are one of the most important risks that we can obviously assess. We can look at that risk coming into credit spreads market. We've seen many sell-offs on the equity space created by a widening of those credit spreads as people seek additional yield from high-risk paper, for example. The volatility structure we've already talked about. In fact, we showed some some trade log ideas here. And we also saw some trade log ideas here that we showed to the guys in the room. You'll see that these trade logs come from today, and you can see the trade log comes from this top edge sell, and you can see into the top edge, you can see here, long volatility carries, hedge short sells. Long volatility carries, hedge short sells. You can see that's at 1953, and you can see that's at 1951. Long volatility carries, hedge short sells. So in other words, we're looking to go short into those narratives. 1953, 1951. So there's 1951 there, 1953 here. There's the two red arrows there, or the two red lines, and we're short selling into that phase. Nice easy money on the short sell. Nice easy money on the short sell coming into that long volatility carries. We short selling the S&P into that phase. And obviously that's how this trade has evolved. It's not been the most sensational, but obviously it is what it is. We can only show you what it shows. We can only show you, we don't have to do anything other than that. We just show you what it shows. Now, obviously, this is the signal that we're getting on this volatility side. There's lots of different ways to dice this one up. But obviously, you can see here that the short sell is coming in from that idea there. And again, that short sell is simply not gone anywhere. It's simply stayed static into the top edge here, and it's obviously dropped off. Now, there hasn't been any long volatility trades coming into the bottom edge, but there has been some long value to buy back into this. And that's what we've obviously been seeing, is the long value to buy back into this top edge again. Maybe the short volatility will come back into the top edge. So what else will we understand? What else will we learn from this as a process? We'll learn about credit spreads. We'll learn about volatility structures. What else will we understand from the process here? Let's take a look at this idea of credit spreads. Why is it useful? So far, so good. NASDAQ. So NASDAQ, this is at 3 o'clock on the 23rd of June. So again, only a few days ago from screenshot purposes for today's little seminar. Credit spread, vol hedgers took constructive. Look constructive, my mistake. Look constructive. Too busy on the long side though, so concerns that the dealers need to sweep these guys off the numbers first. So we're looking for the price to sweep these guys off the numbers. So this is the chart that accompanies to this tweet. This is the chart that accompanies the tweet, right? So what we were thinking was they were going to sweep this trade to take the market bid out of this area. And we said that from this trade. Credit spreads look constructive, but the chart was too busy. So what do we mean by busy? Well, we'll obviously touch on that when we start touching on the order flow aspects of trading. So when we look at the order flow aspects of trading, it's too busy on the long side. And if the market's too busy on the long side, guess what? We don't want to be long. Do you want to join the end of a busy queue, last to the party? Well, trading retail, you generally join the end of a queue, don't you? You join the end of the limit queue, and you join the end of the price action queue as well. Join the end of either of those two queues is guaranteed to lose you your account. So therefore, when I tell you that this market is now looking too long, then of course, I don't want to be buying it. Even though I want to buy it, I don't want to be buying it. I want to buy it at a discount price. So what are we now expecting? Well, we tell you what we're expecting. The dealers are going to need to sweep these guys off the numbers first. And guess what happened? Look, see where the one is? Look at what happened where the arrow is. They swept these guys off the numbers, didn't they? And obviously, once they swept these guys off the numbers, you can see what happened next. So we obviously started to wait for the price to go bid. We started to join into the trade as the price moved off the bottom edges. This is what we call the tipping price buy. We lent against these little stops here. We lent against this little activity here. We went long, and you can see obviously a little 5 lot in that trade suddenly was making $4,500 profit. Simply by something that we'd already tweeted in advance, we're now taking a trade which is now around about 5 minutes later, 6 minutes later. You can see approximately 15 5s to 15 10s. This tweet came out at 1500 hours. So 5 to 10 minutes later, we're now buying it in line with our tweet, in line with the scenario. I mean, did that scenario paint almost perfectly. Now, you might be saying, well, you've perfectly cherry-picked an example there because it looks almost exactly like you tweeted, right? Well, yeah, that's exactly it. We're showing you this idea of developing out a scenario here and how possible to develop out these scenarios based on simple knowledge of what the market is going to do next. I don't want to know what the market's already done. The value in that is next to nothing, right? The idea of that is rubbish. The idea of that is incredibly retail. If the market's already rallied, I don't want to be buying it at that stage. I want to be buying it, but not at that stage. So obviously we look at these as ideas. Now, how do we start to get ahead of the market at that stage? How do we start thinking about the market in terms of getting ahead of these narratives? It comes from this concept called benchmarking. The idea of benchmarking, the idea of looking at this trade here. This is an oil trade. You'll see the time of the tweet or the time of the message. You'll see that the message says oil macro, commercial offer watch. I don't think there's any doubts about what that trade is. It's a sell trade, right? It's a commercial offer watch, and it's 8 o'clock London time in the morning. You'll see that it's on the 23rd of June. Again, this is when I put the slideshow together, was obviously for this presentation tonight. So obviously most of the stuff was done at the weekend from Friday's data so that you could have something to look at today, because I was working today, of course. So obviously when we look at that trade, we've now got this commercial offer watch at 8 o'clock in the morning. We are now looking to get short into the markets. So guess what happened at 8 o'clock in the morning? They ran the stops at 8 o'clock. See how the candle is 7.55? Well, that candle on a 5-minute chart, that candle on the 55-minute, means that that candle there formed at 8 o'clock on the dot. That green candle was an 8 o'clock closing candle. In other words, as soon as that green candle closed, you were getting told that commercials were looking to offer into that candle. Not after the candle sold off, but before the candle sold off, before the sell came in, before the trend broke, before. In other words, not after the event, before the event. So we're now looking to take advantage of that storyline. And when we look at that as a storyline, we start thinking about all the elements that give us this idea of benchmarking. The red RGL, which is part of the matrix. The time of the day. The time of the day here was the Brent market open. The wholesale price level, which is the 69 evens wholesale price level. The volatility expansion that will come in because of the time of the day is always going to be something that we're trying to take advantage of. Level 2 liquidity, in other words, there's a drive into stops to get liquidity for the short sale. A strong dollar was developing in the background. There were some trapped buyers visible on this screen here. You see some buyers getting trapped up here. We've obviously got that commercial trigger. And when you put all of that storyline together, it's called a benchmark. A benchmark means it's almost a banker bet to be short selling into that as a trade. Short selling it, and we get this brilliant idea developing. Now, obviously, the idea at this stage is you're very early to the party. You're trading like a professional, not a retail trader. You're not waiting for a candle confirmation, if you like. You're trading it according to what the order book's doing. In other words, you're taking a local's view of the market and looking at the buying that's coming in and saying, well, I can't fade against that buying, but I can put a sell stop order in against that buying if those buyers get themselves a little bit exposed. So when we're looking at that as a sell trade, we want to see that buyer getting trapped. We want to see that buyer getting themselves stuck in that area because they're going to puke lower down, aren't they? They're going to puke their positions if we were to run the stops down towards the bottom edge. The value on that swing ended up $900 per contract. So we short sold it here at 69 evens, and we closed out our positions at 68.10 for $900, and it only took us under an hour to get that $900 out of the market at that stage. And it's very obvious indeed for anybody that's running this. Now you might be saying, yeah, great examples of some great cherry-picked examples. Let's take a look at some other examples that are cherry-picked straight from the tree. Let's take a look at some other examples that we cherry-picked. 21st of June, let's take a look at this oil trade here, 21st of June. Fueled by the dollar weakness, remember time stamped on the Twitter, fueled by dollar weakness, short-term demand, it's been easy to jump on board the long side. That short-term demand has now leveled out. So we wait to see if it starts to drop off, assisted by dollar strength, currently preferring very passive top-line shorts. Last night, on the 21st, so this is the next day here, the 22nd, passive shorts. So in other words, I am already working that same top-line short. The top edge is, however, very fragile. It'd be easy for the bulls to take back control. But once we started to get that top line getting swept, we were able to get back control in the short sale. We aggressively re-entered the short sale there, and the trade went for $2,500 on the swing per contract. Is it just oil that we see these? Well, equities. With the options exits seen and the rising gamma line, we didn't see buying at the close, suggesting hedgers were holding short equity positions through the Bank of England. We already talked about that. We talked about that idea that the Bank of England did 50 basis points. So watch for evidence of bids into the delta. And that's exactly, tomorrow has a bullish skew. So we're telling you in advance, this was on the 21st of June. Tomorrow has a bullish skew. Watch for bids at the markets. Yeah, watch for that, right? That was on the 21st. This is the 22nd, the day after. That idea of running the cash market open, running the buy opportunity, made us $3,600 per contract on the swing just by knowing that was going to happen. Now, we don't know it's going to happen 10 hours in advance. Things can change. We could have an uprising by the Wagner Group against Putin. We could have an uprising by the Proud Boys against Biden. We could have an uprising by the woke brigade against Rishi Sunak. I don't know. We could have anything happening anytime for 10 hours, right? So one of the things that we understand is that things change, the market changes, the model changes, the story develops. We're not held hostage by a tweet. We have got the ability to change our mind as the day progresses. So when we understand these ideas and we start thinking about these as processes, we can start considering how some of these trades take place. We can see that this is the wheat trade here for 120 points. This is obviously building into the storyline of understanding how the actors play. The idea of buying the dip here and the idea of selling the rally here is highlighted by these bands of color. So what are we doing with this as a storyline? Well, we've got two specific classes that we're going to be running out of this. There's the scalping class, which we are starting tonight. The scalping class, which has the Nash game theory narrative. The idea of looking at Nash equilibrium, the idea of game theory, the idea of who the actors are, looking at the weak versus the strong traders, the idea of the market maths behind these as narratives, the idea of stacking and pulling, the idea of Charlie D transition trading, the flip, the idea of fades, tips, and BSG squeezes, which are transactions themselves. They are trade setups, if you like. The idea of what the big board is and what it looks like, the VWAPs and the RGLs. The idea that RGLs and these ideas here are simply derived from market information, but they're also derived from the matrix. They're derived from the prior day's matrix. They're derived from market-derived information. They're also taken from dealers' information. Knowing what these levels are and how to trade from point to point allows us to make a lot of money. What else are we going to learn? We're adding market internals to this. We're adding the concept of LVNs, which is simply from things like profile or what have you, and obviously what LVNs to use, and the idea of bracket trades. Where are the brackets and what are we going to be looking for from these brackets? If you decide to move into the full class, of course, then we're going to be moving into the rest of the equity narratives. We're also going to be looking at oil supply and demand, the spreads, the crack spreads, the Brent WTI spreads, the inventory releases. And we love a good inventory release. The gold, we're going to be talking about the blue line spread, the metals, the relation to credit spreads, the bonds, the 5s, 10s predictor, the absolutes, and the curve logic. Forex markets, we're going to look at carry and fund drivers. We're even going to look at ags in terms of spreads. We're going to look at fundamentals, technicals, and order flow. People say, Is it fundamentals, or is it technicals, or is it an order flow based class? What? I don't understand those stupid questions. And they are stupid, because a lot of people in the retail space, they go down one road and one road only. Trading is not about going down one road and one road only. It's about going down all of these roads. Price action, index arbing, statistical arbitrage, spreads and pairs trading from the full class, which is what we do every single day during the day, 5 days a week. So when we think about these ideas going forward, we think about RGLs and the big board. When we look at RGLs and the big board, we look at trades like this. We can see, for example, here, we're looking at this and we've got a bracket winner for $1,200. You'll see here, bonds at 1140 that night, 1140 that night. We've got the overnight bracket is 135.29 to 136.07. It's a buy side break above or a sell side break below, based simply on the bracket. And obviously the idea here is, of course, if we break the bracket high, we should be long. And obviously if we go above that bracket high, that trade made $1,200. Now we obviously can buy into the bottom of the bracket by understanding some of the other components. What else do we learn? Dealer brackets. When we look at the dealer buckets, which obviously is a different thing from brackets, that's not a misprint. So when we look at the dealer buckets and we look at the price of volatility, for example, they've kept us on the right side wonderfully. Friday had a small bearish bucket, confirmed only in the last 15 minutes of trade, so the low energy nature of the day isn't surprising. Perhaps dealers were expecting today's longs to liquidate to any upside this week. Based on long-term and short-term volatility, we know what's likely to happen next. You'll see when that tweet took place, it was on the 23rd of June. In other words, it was just before. It was just before the trade took place. What was the trade? Well, the trade was a short sell. You can see it's 12.5 under 10.5 on the right-hand side of that chart. You can see this trade here. 10.5 at the top, 12.5 at the bottom means that this market is bearish. Bearish for the day. Bearish for the day. So what happened next? So obviously we sell the closing bell here. We sell the RGL here. And we try and make money for the next day. What happened next? You can see what happened next. This was the outcome. So we short sold the closing bell here, and the market opened gap down the next day. Just the same way as we bought the open here, we bought the open here, and we rallied all the way back towards the top edge because we were waiting for the Bank of England into that trade. And we can see that that narrative allows me to make a fortune in that short sell in the overnight session. And obviously the idea is that that's probably going to be a sell the next day, and you can see the market really struggle to regain the gap during the course of the remaining day there. So that's what's coming up. So let's get started into today's classroom. So the best thing is to take a little 60-second break, allow you to get a coffee or whatever, and then we'll get started into today's classroom, of course, which is understanding the various actors, understanding the dealer's bid offer, and starting to think about the market from a market maker's perspective. So let's take 60 seconds, guys, 60 seconds.
Thank you so much, Ray. We love it. We love it. I know, right, Steve? Deep breath. The turtle wins the race. We appreciate you guys coming in. And for those of you that were not in when we first got started, welcome in. We did get started right on time. Ray dove right in. So hopefully you're able to say, oh, we're in class. I said we're having class. Hey, Miss Nessie, how are you? It's so good to have you in. It was so nice speaking with you and James the other day. And guys, once Ray is done, I will give all of the details. But yes, we are going into class the rest of this week. Tuesday, Wednesday will be with Ray, 3 o'clock, same time. And Friday will be with Ray. Thursday, we're going to have David and possibly Greg come in and do a tech session on our order flow tools. We have the best. The one thing that's amazing about, and our guys in here will tell you, the tools that our guys use were made specifically for what they're wanting to see in the market based around what they've learned from Ray. So I think we have the absolute best tools available in the market, and you can only get them here. How about that? Yeah, Peter, it is good to see that he's it could be God, could be good, that he's maintaining that let's get in there and turn on the fire hose. He's not messing
Okay.
around. This is like a real desk.
Yeah, we're getting started, Kim. All right, so let's move on to this next phase, guys. Okay, so we've got dealer offer and dealer bid 80 over 60. Okay, so bid offer spread 20 on this. So it doesn't mean anything. It's just a series of numbers. We're trying to keep the math easy for you guys, right? So dealer offer spread, dealer offer, bid offer spreads 80 offered, 60 bid. And let's do a little transaction here with this spread. Let's do a little transaction. So obviously, based on that trade there, we're obviously wondering, well, what happens next? Well, let's do the numbers. Let's do the numbers. 10 buyers come in. 10 buyers come in. What price did they get? What price did they get? 10 buyers come in. What price did they get? I mean, you've got to know this stuff because this is the real basic, right? We're going to get 10 buyers coming in and they're going to get filled at 80. Okay, so that's pretty straightforward. I think everybody kind of understands that. 10 buyers come in, they're going to get filled at 80, and that's them now long 10. What's the market maker's position? The market maker's now short 10 at 80, correct? The market maker's short 10 at 80. They're bidding 60. They're short 10 at 80. The market maker's got the opposite side to that trade. So let's assume the market maker does nothing with this trade at this stage. And let's assume that what happens next is that 20 sellers come in. What price do they get? So 20 sellers come in, and obviously they hit the bid. They're selling the market. They're not joining the queue for the trade. They're hitting the bid. So they get a price of 60. So what's the market maker's position? Well, the market maker, obviously, if you do it for the transaction alone, the market maker obviously has just bought 20, haven't they? The market maker's just bought 20 at a price of what? At 60, right? But the market maker was already short 10 at 80, right? So the market maker was short 10 at 80. And obviously, therefore, they've bought 20. So what does that mean the market maker's net position is, assuming they haven't had any positions prior to this? The market maker is now long 10 at a price of 60. What's the market maker's profit on this so far? Yeah. Market maker's profit so far is 200 points. Everybody up to speed on that? Everybody up to speed? So the market maker made a profit by being short 10 at 80 and buying 10 back at 60, which is 20 points. 20 points on 10 contracts is 200 points. So the market maker is in profit 200 points at this stage. Okay. So let me just give you a new offer. Let me give you an offer on this one, guys. So the offer comes in, the market maker comes in with an offer at 65. What are you bidding? What are you bidding? You're the market maker. What are you bidding? I want you to come up with an actual price, guys. Fabio's done this before. Fabio's done this before. Bill, you're not going to get filled at 15. You're not going to get filled at 15. Well, you might. I mean, you'll be a genius if you get filled at 15, but obviously that's up to you. But obviously, Bill's pulled away his liquidity and he says, you know what? Sod you guys, I'm not taking that deal. Which is absolutely fine. It's a decision you make, right? It's a decision you make. But as a market maker, what's your job? As a market maker, is your job to get filled? Well, of course it is. As a market maker, your job is to take two-way money. Your job is to buy and sell. It's not to be long one side or short one side. It's to try and buy and sell. So whilst Bill's not wrong about 15, he's not probably going to be able to get a balanced book here. But that might be a purpose. That might be a decision that Bill wants to make, right? Bill might want to not be buying at any price. So based on the Nash equilibrium, does anybody know what the Nash equilibrium means? It's obviously something that works quite nicely inside the world of game theory. And the idea is that unless something changes, nothing changes. Right? So unless something changes, you might say, what the hell does that mean? That's just words. Well, it actually isn't just words. What it means is that the market will continue doing what it was doing unless something fundamentally acts upon the market. It's almost like a Newton-type physics equation. Unless something happens that's going to change the story, the market story stays the same. So in other words, all the people that said 45 for the bids, well, you're obviously understanding a little bit about the Nash equilibrium. If an offers came in at 65 and the bid offer spread was 20, then we're obviously looking at the market saying 20 sellers, 10 buyers. I'm going to bid 45 for that. Now, because there's 20 sellers, you might say, well, I don't know if I do want to bid 45 because there's more sellers than buyers. I might want to bid 44, but obviously because the offer's coming in at 65, then you can obviously understand that 45 is probably a reasonable price to pay inside this model. Now, obviously, depending upon how the bids and the offers pour into this trade, of course, that's going to start having a big impact on your bids and offers, is it not? So in other words, would you offer and bid the same if this trade was now offered here at 65.45? If I then said that if there was, for example, scenario A, scenario 1 or whatever, and I said that there was 100 buyers came in, or scenario 2, there was 100 sellers, would that change how you would approach the pricing of the market next, on the next candle? Let's assume you're offering 100 liquidity on bids and offers. Let's assume your book is 100 lots wide, 100 lots deep, right? So you've obviously got 100 lots on these two prices, and somebody comes in and buys a whole lot or sells a whole lot. Well, of course, that's difficult now, isn't it? Because you're going to be in a massive position here. They don't really want, and you just want off the deal. You just want to try and pass that massive position off to somebody else. So obviously, if the scenario 1 comes in and there's 100 buyers, what price do they get? Well, they get obviously 65. And if 100 sellers then come in, they get 45. You've just killed it, haven't you? You've just made 20 ticks on 100 contracts for 2,000 points profit. Now, that would be a deal, wouldn't it? That would be the best deal possible. But these are two distinct, separate scenarios. So obviously, if 100 buyers come in and no sellers come in, you're not going to offer 65, are you? You're going to say to yourself, you know what, I'm going to pull away on this one, right? So let's get rid of this scenario here for a second. Let's get rid of this scenario. So 100 buyers come in and no sellers. Give me a two-way price, guys. Give me a two-way price on the next candle. Two-way price. Susan's gone really aggressive on that one, 85 over 65. Okay, I can buy into that, of course. That seems reasonable. Anybody say, wait a second. Why would you do 65? Because obviously at 65, you're not going to make any money. You're not going to make any money at all at 65, are you? So the better scenario would be what? What would be slightly better? Well, the slightly better scenario might well be that if you were to start bidding at, say, 64, at least you'd make a tick on the trade, right? At least you'd make a tick on the trade if you bid 64. With that number of buyers, the one thing you don't want is you don't want to fill another 100 buyers at 65. So obviously in that type of situation, I don't know if I want to even offer 85s. I might even want to offer, for example, 90, 95, so that we close off the trade to the buyers. And if they do want to buy, because we don't know what the hell's happening here, right? Let's assume that is a big buyer coming in there. We don't know what this guy knows. We don't know if this is well, for 100 lots, you'd imagine it is somebody that knows something about what's going on. So we want to make sure we don't get stuffed by this buyer coming in and buying another 100 contracts very aggressively against our positioning. So we pull away our bid offer. We pull away our offer in this case, and we jam up the bid so that if somebody comes in and sells at 64, they get a great price, and that clears our book at plus 1 tick profit, right? So we get a 1 tick profit on 100 contracts. Well, we'd be delighted with that, would we not? But worst case scenario is we've managed to pull the price away on the bid. This is the opposite to Bill's 15 bids on the previous example. We've now pulled away the offer so that if anybody wants to buy from us in the next candle, for example, they're going to have to pay 95. So I'm protecting my upside a little bit from massive buyers coming in by pulling away the liquidity. And now we know something that's happening, don't we? Now we know the Nash equilibrium's changed. Instead of the market now running 20 tick bid offer spreads, it's now running 30. In other words, the market's getting more volatile. When you quote this bid offer spread, what is it we're actually seeing? What we're actually seeing, of course, is a candle. Because if you think about what a candle is, if you start from a basic starting point from any marketplace, if you look at this bid offer, and I put the offer there and I put the bid here, and now you now say, well, the bid is now 60. So the 60 bid here, and there's the 80 offer here. What is that? That's a candle, isn't it? That's a candle, because obviously if somebody sells at 60, if somebody sells at 60 and then somebody comes in and buys at 80, well, the 80 is the second trade at this stage, isn't it? So obviously if that's the case, what happens to this trade? Well, obviously somebody pays 60 and then somebody comes in and buys it and the trade trades 80. So what happens? The candle forms and it's a green candle, isn't it? So in other words, the bid offer spread is the candle and the candle's 20 ticks wide. So if we go ahead and do the same thing on this example here, and we've got 65 offer and 45 bids, and obviously let's assume the last trade was down at 45s here, and then the trade comes in, the buyer comes in here and trades 100, and they obviously drive the price into this candle area here, so that's the closing candle there. What happens next? You're now bidding 64, which is just here, and you're offering now 95, which means the next candle is obviously going to be something that looks a little bit more like that, isn't it? It's going to be 30 ticks wide. Slightly over-exaggerated the length of that candle, but it doesn't make any difference. I think you get the basic idea. The candle shape takes the form of that toxicity, doesn't it? Like Sammy mentions. So the candle takes the form of that toxicity in terms of those bid offers. In other words, that's part of the Nash equilibrium. The Nash equilibrium in this case is widening. The normal is widening, and therefore we would expect to see that continuing to develop. This is why when we think about trades, we can think about channels, and that's exactly what a channel is. The market maker doesn't need the price to go back to the bottom edge here for them to make a profit. The market maker actually only needs the price to go inside the prior candle and for 100 sellers to come in to make a profit. And they don't even need 100 sellers. They just need enough sellers to offset the risk. And obviously that means that the overall shape of this is now bullish, and we want to try and stay on the buy side of this marketplace. So this is when we start tying in things like deltas in price action. Because if we think about it, let's go back to the first example so that we're all on the same page with regard to what deltas mean and what volume means. So the first trade comes in and we've got 10 buyers coming in at 80. First trade, 10 buyers coming in at 80. What's the volume and what's the delta? What's the market volume and what is the delta on this trade? 10 buyers come in at 80. That's all we're dealing with. 10 buyers at 80. What's the market volume and what's the delta on this candle? The market volume is 10. What's the market delta? Plus 10, right? So volume isn't plus or minus. Volume is just a number. But delta is plus or minus, right? So volume is 10 and delta is plus 10. So the volume's 10 and the delta's plus 10. And then, of course, 20 sellers come in. So then 20 sellers come in at 60. What's the volume in this candle? And what's the delta in this candle? So it's the same candle. 20 sellers have now come in and they've paid 60. So what's the total volume? Well, the total volume is 30. So the volume is 20 plus 10, right? So the total volume is 30. And now the delta is minus 10. The delta is minus 10, right? So obviously, if this candle is formed the way it's formed, what on earth happened to those 20 sellers? Well, if the candle formed in this way, those sellers are now looking at a terrible losing position, aren't they? Because the last traded price was 80. So if this is the actual candle that formed from this narrative here, we can see that that is what a condition that we call what? What is that condition called? That's called absorption, isn't it? That's called absorption. And one of the things we learn about trading the order flow of these types of setups is very straightforward. If there's an absorption, you cannot use a buy limit order. Because if you use a buy limit order, the key to that idea there is very, very straightforward. Do not buy from heavy selling. Never buy from heavy selling. Because if you buy from heavy selling, you're simply the guy that's standing in front of a falling knife trying to catch it. Right? So when you're standing in front of a falling knife trying to catch it, guess what happens? You normally get your fingers chopped off. So unless you know what you're doing, do not stand in front of this guy. Do not stand in front of that short sell at 20. So this is called absorption. So the way we trade absorptions is, of course, we trade called a lean. In other words, we lean against the seller at 60 and we start bidding 61, 62s. So this is the kind of trade that we would then learn to do. We would bid 61, 62, maybe 65 or whatever. We would bid against that seller at 60. So we would put in a buy stop order, perhaps at 61, 62, 63, 64, 65. And of course, the idea here is if the price starts to move through, our stop might get triggered. And obviously that would lead to perhaps a fill at maybe 65, 66, 67s instead of the 80 offer, assuming there was some additional liquidity coming into this picture. So when we start to understand this idea, this model, it takes us to a view of, well, what does that mean in terms of the market makers and the type of actors that take place in every chart? What does it mean? Well, let's have start that one again. Let's have a little think about what it means. When we think about a market and we think about a shape, we're always left wondering who's doing what at what price. If I draw a chart, and I draw a chart that looks a little bit like this, for example, you'll probably all have a fair idea about what the hell's going on. You'll probably have a fair idea, but the key to this is, of course, recognizing who's in the market doing various things in terms of any type of price action. And we can start to recognize simple things about who is involved and how the market behaves when people get involved. When we see a market that's doing that, of course, that's those big candles where the market makers are pulling away liquidity. They're pulling away bids in this case. This could be that bid that Bill put in at 15, for example. So Bill didn't want to buy any business here, would rather buy at 15s, pulls away his liquidity, and of course the price drops to 15s if that's the nearest bid. So in other words, we call this phase a withdrawal of liquidity, don't we? We call this phase a withdrawal of liquidity, and this is the kind of phase also that we normally recognize things like momentum-based HFTs. In other words, the market is now driving, the HFTs are now driving this market, they are now driving that price action. The one thing you don't want to do here is you don't want to buy against this. You don't want to be the guy that starts to stand in front of this. This is usually a very low volume period that will have high volume candles, but as a period, because the price is spread out so wide, this will be what is normally termed a low volume node because the price is spread out. The individual candles will be high, but the volume in terms of profile, for example, will be low. As the price starts to jam into the bottom edges, of course, there's always a reason. We understand what's happened here. Guess what's happened here? High volumes came in and jammed the price. So we normally can recognize this phase here starts from a high volume surge on the individual candle itself. So we get this big surge in volume here. And this is what we call aggregated demand or supply. In this case, they're aggregating supply. Now, what does that mean? Aggregated supply sounds like a big made-up phrase, doesn't it? All it means is that there's a lot of people perhaps taking trade out here. It's getting aggregated with other things. So in other words, sellers are taking profits. Some commercial buyers may take interest. Low market makers are up again. So supply. It doesn't mean it's bullish. It just means that it's aggregated supply. And this carries on now for a while. So we get this aggregated supply coming in, and obviously the price drifts as it normally does because the HFT sellers are still connected. We get another break to the downside, and usually this also has a high volume node against it. In other words, a high volume candle into a low volume area. This is something that a lot of people are surprised at, because when people talk about volume, they don't really clearly mark out. Some people do, of course. They don't really clearly mark out what they're talking about when they talk about volume. So let's just be clear about what we are talking about when we're talking about volume. The two different kinds of volume is the spike volume or the candle volume. And then, of course, there's the profile. Now, these are very, very interesting concepts as far as a supply-demand curve are concerned, because they are in nowhere near usually the same location. Usually nowhere near the same location, because profile volume usually comes from low volume candles. And a lot of people kind of trip over this. They don't quite understand this at first. And then these spike volume candles usually take place at low volume nodes from a profile point of view. Now, that's not a bad thing to know already, isn't it? From a profile perspective, a high volume spike candle means it's probably going to be a rejection of a price area. Is that useful? Well, of course it is. Because if we know that this is going to be a rejection of a price area, well, we want to deal in here, don't we? This is not a two-way money price. This is usually creating what is called an imbalance. So therefore, these are the kind of locations where we want to do trades. Now, whether that trade is recognizing it and selling down into it, or recognizing and fading it, or whatever, we know that high volume spike candles are low volume nodes, and we know low volume nodes are, as a rule, imbalanced candles. So whilst you might say, but a high volume candle has got to be balanced because there's a lot of volume in it. But is it? Because that volume could be all market making against people getting jammed. In other words, there's a reason why high volume appears. We've already established that if a big volume candle comes in, there's always going to be the possibility that the market maker pulls away liquidity. So these are critical to understanding some simple basics of any trade setup. Where does this aggregated volume come in, and what does it mean? Where is it located, and how can I take advantage of it? An aggregated volume spike could always be a fade, but it could also be a continuation from lower prices or higher prices. So we've got a lot of information already starting to build. Now, what happens next? Well, it all depends, because obviously in this area here, the momentum traders are no longer going to get paid, are they? The idea of being a momentum trader in here means, of course, selling into the momentum. So they might sell the break of this price. They might sell the break of this price. Do they get paid with the risk? Not really. They're not really getting paid with the breaks here, are they? They might sell the break of this price here. They're not going to get paid with these breaks. Now, the interesting thing is that if they do sell of these break trades here, of course, these will probably be quite high volume candles as well. And obviously, they're not getting paid. So what's going to happen is they're going to start getting a little bit switched off. Most of these algorithms will just simply get turned down a notch, and then eventually they'll just be switched off entirely. They're not making any money. There's no momentum in the markets. It's not volatile. So obviously, how does this take place? What is taking place in here? Well, this could simply be a market maker now balancing their books, or it could potentially be a big commercial operator buying into low prices, with a view, of course, of then quietly but carefully then marking up the price and then driving the price away from this area. Now, obviously, recognizing this interns exercise, this is what we call the interns exercise. It's the first thing that any intern in the bank learns, is the idea, the process about trading with the flow of structure. So that takes us to the next part of this little exercise. How do we determine what side to trade on? Well, of course, that comes down to a couple of key components. First of all, price action. Now, one might say, price action, really? Seriously, professionals talk about price action? Well, of course you've got to talk about price action, because we've already established that price action tells us about what? We've established that price action tells us about the Nash equilibrium. It tells us where you guys were putting your bids and your offers into. So we're already aware that the price action is very important. If the price drops and pulls back to here, we're already aware where you guys are going to put your bids back in, aren't you? The bid is going to come in, according to your calculations, the bid's going to come in probably about that price, right? So that means that there is room to sell short into that drive, isn't there? There's room to sell short as the price drives through this area here. The market maker bids will be at lower prices because the offers are at lower prices. That's the Nash equilibrium. So a market that's in trend will stay in trend until it's acted upon by something else. And that something else could be volume, of course. Volume is a Nash equilibrium. You might be saying, what do you mean it's a Nash equilibrium? Well, Nash equilibrium, remember, is if nothing changes, right? Nash equilibrium is said to be in place if nothing changes. Well, if this volume was doing this, and this volume was doing this, and this volume was doing this, nothing's changing, right? So that's the Nash equilibrium. Nothing's changing. But if all of a sudden we got a volume that did that, is that the Nash equilibrium broken at that stage? Do we get this idea that the Nash equilibrium structure has taken some sort of break? Well, against a volume narrative, the answer is yes, it has. The volume narrative suggests the Nash equilibrium is broken. The price action says not, but the volume says yes. So this is something that's also important to us going forward. We can recognize that this is a break of the Nash equilibrium. Something is taking place that we want to explain, and it usually leads to a price rally. It usually leads ultimately to that price rally that you'd have expected. Now, obviously, if that's heavy selling coming in, you'd imagine that they are going to be aggressive on that short sell. They're going to start selling back into this aggressively, because that's what you guys said you would all do, remember? You guys all said that when we said that there was a 100-lot buyer coming in, remember, you were very aggressive with your buy pricing. Well, if you're very aggressive with your sell pricing because of this big seller at this low price, then of course this price should not pull back very far. The price should only just pull back a little bit, certainly not halfway. The price should pull back a little bit and explode south, because remember, you pulled away all your trade. You pulled away all your bids or all your offers. So in other words, we know what should happen next based on these simple basic structures. We know what should happen next, and therefore we're watching to see if it does indeed take that form. So these are all simply just observations. But what does it mean in terms of trading? Well, obviously, from an interns exercise, it's relatively straightforward. We can look at the pace of move. We can look at the idea of structure. This is the NASDAQ on a 1-minute chart for today's marketplace, basically since we've taken the afternoon session. So when we look at the NASDAQ from today's marketplace, we can see this idea of phases of very, very aggressive selling, fast money selling. We can recognize the Nash structure based on that fast selling. How do we know that? Well, we can look at aggregation volume candles. If we look at aggregation volume candles, this is basically just big volume down candles. Which ones are big volume down candles? These ones here. So when we see these big volume down candles, we can look at the response to those big volume down candles. We can also ask questions. What is the big volume down candle? There's two things it can be. It can be an exit of a sell, or it can be a brand new short sell. So it could be the walk away from a sell, which obviously took place during this phase, which led to a buy rally, or it could be the new positioning of a sell, which led to that fall. Which one's which? Great question. Because obviously, if you bought this one and you bought this one, it did okay. If you bought this one, you lost money. If you bought this one, you might have scratched out and lost money. If you bought this one, you definitely lost money. So which one is it? Is it a buy trade or is it a sell trade? Wouldn't you like to know? Well, that's exactly what you will know. That's exactly what we teach. That's exactly what we cover. So when we think about this as a Nash equilibrium, we can see this volume joins that volume, joins this volume. And based on that volume joining that volume and joining that volume, we can recognize the Nash equilibrium. So the market maker bids these prices. So if the market maker is bidding these prices, the market maker is going to offer exactly the opposite, assuming nothing changes. So based on that bid that's coming in on those prices, we just join the dots. We can also join the dots against those offers. If we join the dots against those offers, of course, there must have been a change to the Nash equilibrium here. There must have been. So when there was a change to the Nash equilibrium, it doesn't mean the market's now bullish. On the contrary, the market's still bearish. Why is the market still bearish? Because obviously for that Nash equilibrium to be there must be sellers at that price. There must be supply at lower prices. There must be supply at lower prices. On the basis that there's supply at lower prices, we want to sell into that supply. We want to go with the flow if we can, assuming everything else stacks up. But because the Nash equilibrium is broken here, we have to go back to the next key level. And the next key level is the market maker sell. The last time we traded this, the market maker sell, the last time we traded was obviously here. So we know that we can now look at that as a market structure to get that short sell on the books. This is, of course, a low volume node. We know it's a low volume node because when the price breaks structure like this, we know that that is the low volume node area. And we mark the price accordingly. The idea is to always sell down into supply at lower prices. If that supply is commercial buying, that's okay, because commercial buyers at lower prices are commercial buyers at lower prices. They're not showing up at higher prices yet. Our job is to try and be short into that supply. Our job is to keep selling with the right Nash equilibrium. So obviously selling short into this area would not have been too difficult to get that short sell into place. The idea, of course, is we now know where the next volume is going to be. How do we know where the next volume is going to be? Well, isn't it obvious that the next volume is always the next breakout trade narrative? So when we see a big level like this and we see a big level like this here, we know the next volume is probably going to be here. Well, if that's not interesting information, I don't know what is. Because if we know that this is going to be either a continuation or a reversal, all we have to do is decide which one it's going to be. If we already know that the volume is coming in here, and we know that that volume is critical to what's going to happen next, surely to goodness, we know exactly how to trade here. If we know what that trade is going to be, then we know that that's a continuation short, in which case we can sell into that price, and we can sell through that price, and we can obviously try and make the next move. If we think that's a buy trade, then of course we can start looking to buy into this. We know commercials are passive buyers, therefore we know that this price will probably fall through this area. So we don't have to necessarily buy the box. We can buy the break of the box lower for a buy reversal, but we need to know how to work that out. We're going to touch on that as we go into the second half of this little classroom. Now, obviously, what happens next is, of course, this Nash equilibrium and this Nash equilibrium is almost the same price. The structure is very flat now, isn't it? So when we see that structure is very flat, we know that the Nash equilibrium is also very flat. In other words, we can see that the Nash equilibrium, and this is certainly flatter than it was before. Now, obviously, the price picks up. But we can see what happens when the price picks up. Nobody shows up at lower prices. There's no volume here at this stage. So obviously that's quite disappointing, but obviously when we see the price starting to rotate back into this area, surprisingly enough, there's the high volume coming back in. Because there was no volume here, we really needed to see that rotation, because for us to sell into supply, we need to be above this red area, don't we? We need to be above this kind of price bracket here. So as soon as we went above that, the opportunity to get short back into that trade was starting to become visible. We now get supply here, and obviously the same thing is true. This is now supply. We've now got the Nash equilibrium joining the dots from here to here. So there it is. There's your Nash equilibrium. We just join the dots. If that's where the Nash equilibrium now is, we can obviously now draw that against the next key price level. We can look at where the dealers are going to sell into this. If we draw that dealer sell into this chart, we can see that that dealer sell is coming into that kind of price area there. We start watching those price areas, and perhaps we start to recognize that little opportunity to tie in a little quick short. Another great opportunity to get short into structure. And another Nash equilibrium sell, another sell, and another sell, driving that price even more aggressively through that phase. But it won't be lost on you that this is exactly how today's NASDAQ is structured. You can see that this acceleration here, this aggressive acceleration, of course, opens the door to a new market maker model. It's a lot more aggressive. It's a lot more withdrawal of liquidity by the bids. And by drawing in that new model, which basically just means joining the red dots, we now know what the market maker model now looks like. It's a lot more aggressive on the slope here, isn't it? It's a lot more aggressive on the slope. So we start looking at that aggressive nature, and we know that we've got to cross the spreads a lot more keenly if we want to do business here. If we sit with our offers too far away, we're never going to get filled. So we want to try and deal, and we want to try and deal a little bit more aggressively into key price levels. So obviously it's up to you how aggressive you get, but obviously the order flow can help us. But maybe you saw an opportunity to sell here or here and another Nash equilibrium. And then the Nash equilibrium stops. Something stops the market here. You can see that this trade here was higher than it was here. In other words, what happened was somebody started to absorb. The Nash equilibrium's changed here, hasn't it? It went slower here, it accelerated here, and now it's actually going up. All of a sudden, something's different. Something's fundamentally flawed in your overall argument about what is happening here. And we can take that Nash equilibrium back to the top side and look at what happens when we touch that price. Demand showed up. Demand. So with demand showing, you're saying to yourself, well, it's still sell side, but I'm now seeing demand at higher prices. This could be a bottom edge getting put in here. This could be a bottom edge getting put in. And guess what happened? A bottom edge was put in. Guess what happened? The sellers disappeared off the charts, didn't they? The red disappeared off the screens to be replaced by blues coming into this bottom edge sequence. This idea of running the price down to go buy side isn't lost on anybody. So we start looking at this demand at this price and saying, well, there's a discount to that demand area. I now fancy the idea of trading back towards the demand. I want to go long into this. The color of the bar tells you what color to trade. The color of the bar tells you we should be buying below that price into level 2 liquidity, into stops, into key structures. And the idea from that trade is, of course, that the bulls show up. The bulls are back in play here. The bulls are now driving. And obviously the idea there is we've now got a new Nash equilibrium starting to form. It's not the most pronounced, of course, but it's still definitely there. And you can see when that price trades back to that Nash equilibrium again there, you can see that roughly at the right time, you can see that the supply starts to press into that as a trade. Now, if you took that as a buy trade, no damage done. You were able to scratch that trade out. You had about 5 or 10 minutes to scratch that trade out for a profit of a couple of ticks or so. And obviously now you're seeing that supply coming back in, so you're able to get away from that trade. Remember, you're trading in the direction of the last color. So when that changes to red, you're now a short seller for the press. You're trying to be short. You're now trying to be working that short sell. And it's a very easy process then to say, well, there was a little level 2 here. I want to sell into that low volume node. And the low volume node was perhaps that little price level there. And that sell came in and drove the price again here and again here. And again, we can follow the Nash equilibrium based on that storyline there. And we can work out where it's going, where it's coming from. And based on that Nash equilibrium, you can see that that selling resulted ultimately in that drive lower. And we can see that into the cash close, you can see exactly what happened here. The Nash equilibrium ran out of room at the cash close here. And that was the end of your trading day. So if all you do is trade into the last supplier demand, you've already recognized a massive improvement in your trading position. You've already recognized how you could have improved your trading results by trading into the last supply and demand. In other words, going with the flow of trade, something we'll focus a lot on in tomorrow's classroom, is going with the flow of the trade direction. But this isn't the only trade direction on the charts, is it? So we can see if we zoom out from the charts there, you'll see that we were pretty much sell side for this entire cash move here, sell side. And then we had some buy sides for this move here. And then we went back short for this move into the closing bell. So by going with the flow of trade, we were always selling into supply at lower prices. We were always buying into demand at higher prices. And if we weren't, there was no trade for us. In other words, we're starting to form an opinion based on the flow of cash. We're starting to form an opinion based on those big volume candles, those big heavy volume narratives. We're starting to see what type of trade we should be doing at what price. We're starting to form an opinion that we can take to the bank. But what else allows us to form an opinion? Well, of course, the big board. And when we think about the big board, we're thinking about what color is the big board? The big board, of course, is the difference in the cash opens and the cash closes. And obviously, the cash open has also got its own big board narrative. If the market's bullish from the cash open, you'd rather be buying. But is that against the overall sell from the big board from last night? Well, we can figure all of that out, can we? We can figure all of that out. Here's today's trades. Here's today's trades. Look at it. You might be saying, oh my God, that's quite an impressive series of arrows. Well, not really when you think about what these arrows are created from. So we have low volume nodes, of course, simply things like previous top edges, simply like a change of behavior here. It's not just the fact that these are the only prices, these levels exist from a lot of different locations. But how do we know whether we should sell this or buy this bottom edge here? How do we know whether we should sell this or this or this and not buy these bottom edges? How do we know any of these things? Well, we know these things because we apply some studies. We apply some ideas about whether the edge is on the buy side or the sell side. We apply some studies to this process. So when we take away the chart there, of course, it looks as if it's very difficult to see. In hindsight's great to see where the high is and where the low is, but how do we know in advance? Well, of course, we've also got the idea of the basic RGLs, the cash open and the cash close. We've also got other things. When we add the cash open and the cash close, the idea is very straightforward. If this is predominantly red, we should be selling. If it's blue, we should be buying. Well, interestingly enough, I sold a lot of business up here. Why was that the case? Why did I sell that phase there? Well, because if you look in the background, this is predominantly still a red market from the big cash open price. The big cash open bracket here was a very strong directional pop. But if we look in the background even further still, you'll see that the cash open comes from the London cash open here. So this market was predominantly and has been predominantly red for the entirety. This little RGL is based around a thing called the market and close orders. The market and close orders is a block of orders that simply come in from big pension funds, big hedge funds. So one of these big block orders, of course, is something that the market makers start to get to know about at 7 o'clock London time in the evening. The market and close order starts directing traffic from 7 o'clock London time. So we know that if the market and close orders turns the market bullish, we should try and go with that direction. We should try and go with that direction at that stage. So that's something that we can pay attention to, isn't it? We can pay attention to the market and close. We can pay attention to the cash open. If the market's red, we would rather be selling it. If the market's blue, we would rather be buying it, but not exclusively. What do we mean not exclusively? Well, of course, when we apply things like what we call the Berkshire line. In other words, if we want to know what Warren Buffett's doing today, would that be valuable for anybody? What do you think? If you knew what Warren Buffett was doing today, would that be valuable for you to trade? Can we all agree that Warren Buffett is regarded as one of the best investors? Now you may be saying, but these are big long-term investments. We understand that. It's not actually Warren Buffett, right? So when we look at this, it's an idea of the market doing what it's doing best. If the market's bullish or if the market's bearish. JP Morgan, they do exactly the same trade. Bank of America Merrill's, they do exactly the same trade. Vanguard, guess what? Yep, BlackRock, they do exactly the same trade. So let's see what these guys would be doing in these trades. Let's see if they're bullish or bearish. Let's take a look. You tell me if you would be buying or selling today based on these arrows. You tell me if there's any trade opportunities to buy or sell today based on that line there. You tell me. In other words, is the buy pretty obvious at the cash open, yes or no? Is the buy very, very obvious at the cash open? Is the sell when that line starts dropping very obvious at the top edge? Well, this is based on these big boys' rotations. This is based on these big boy rotations about how they're starting to position their funds. So if we know how they're positioning their funds, do we want to know that? Of course we do. Do we want to buy into strength? Of course we do. Do we want to sell into weakness? Of course we do. Well, this is a genuine way to understand selling into weakness. So we know that the big funds like Vanguard, the big boys at Vanguard and BlackRock, we know they're getting short here. So if we know they're getting short here, but the index hasn't yet sold off, well, we're getting an early warning sign to get short there. Could the market be blue at that stage? Of course it could. Does that mean that there's no way you're going to ever be a buyer in that scenario? Well, I wouldn't be a buyer. If I was going to buy into that scenario, I'd need a very, very strong discount price to take advantage of that scenario before I would ever play into that as a narrative. So we can obviously understand this as the market developed. Is that a very good sell opportunity? What do you think? Is that even a possible sell opportunity there as well? Could that have been counted as a little bit of an opportunity to get short? But that's even better, isn't it? Now you may be saying, but the other two earlier would have been better as well, surely. Don't call me Shirley, first of all, but yep, you get the basic idea that that these could have been possible sells. And yes, they might have been scratches. They might have been a little profits and a little scratch. They might have been plus ones. So a little quick short sell in there would have made sense, and a little quick short sell in there would have made a little bit of sense. So yes, of course, there's opportunities to now join in with that short sell in line with Vanguard, in line with Warren Buffett, in line with Bank of America Merrill's. So the big short comes back onto the books and we start working that short, and obviously another opportunity to get short again into level two. So all it is a straight line. All it is that straight line coming off that price. All it is that change of behavior coming off that price there. All it is recognizing that that's a great price area to do some business into. And obviously that short, that makes another swing to the low again, and we can see how nice and easy that process was. And if you recall, what did we say in the classroom today? Do you remember we were looking at this very line when I stepped into this classroom at 7:30 this morning, or this afternoon, sorry? Do you remember what I said? Do you remember we came in at this stage here and I was talking about this market, and I said to you guys, whoever was in at 7:30, half an hour before the classroom kicked off, I said to you guys at that time, this is a lot more constructive for a buy trade, did we not? This looks like a lot more constructive for a buy trade, and because it's coming into the market and close orders, I'm expecting the market to sweep south to buy back into this as a narrative. So we now know a scenario. We have a plan of action. We're now expecting the market to sweep south into a buy opportunity. Because it's the market and close orders, we think that the dealers will take the price down to get rid of the buyers. And by taking the price down, it opens up our opportunity to buy into it. And what happened to that trade is we got a brilliant trade attack off the bottom edges here, and we ran the swing, crazy good swing to the upside. You telling me that that's invisible? You telling me that that storyline cannot be seen by you guys? Of course it can. But was it seen at this price here as well? Was it seen at that price? Of course it is. Did it make any difference? Did it make any difference it was seen at that price? Does it also been seen if I draw the same line against that price? Does it make any difference that it was also seen at this price as well? Well, it only makes a difference if you're not confident, Fabio, right? It only makes a difference if you're not confident. If you're not confident about this taking place, then of course what will happen is you'll buy it, nice profit, get scratched out of your trade, and then not buy it again and simply say, I'm doomed, I'm finished, I've had enough. I'm doomed, I finished, I've had enough from this trade and I'm not going to do it again. But that's where you make the mistake. Because ultimately what happens to that mistake is, of course, this is done because they are exactly doing what they want to do. They're doing and pressing you to try and throw away your good long positions, aren't they? They're trying to get you to throw away your longs. And the way they do that is to try and get you to put your stops at break even or -1 or -5. And then they're going to run those stops and get you off the numbers. And they're hoping that your confidence is taking a bashing because you've now went twice long and you've not made money on any of those trades. You're costing you commissions. And you say, you know what, I'm not going to buy it anymore at the bottom edge. I'm going to buy it at the top edge. And you start coming in at the top edge and you start saying to yourself, right, I'm going to buy it in here. And what do they do to you? They pull away the price and you end up getting a god-awful fill. You buy into that candle right there at that top edge. And what do? The first thing they do is they take it back inside value, because where's your stops? Where are you going to put your stops if you bought there? Probably one tick inside that previous level. And guess where the price goes to? 2 ticks inside that previous level to stop any buyers out right at that point, yeah? Because retail traders are so predictable at where stops are positioned. As soon as the price breaks north, everybody's stops will be that break line, won't it? It'll be that break line because that's where they are expecting the buyers to hold. The buyers don't hold it. The price drops through it by 2 ticks. Stops everybody out. So in other words, if you're going to buy it, you buy it there. You don't buy it there. You buy it here. And you go back in for the press at that stage. So this is obvious. But obviously it's obvious, and then we start to see the sell developing in here, and you can see what happened to that sell. Is that sell visible? Well, it lost its visibility here for a short period, didn't it? But it regained its visibility aggressively here off the 85s. Agreed? We might have had to have crossed down into the price, but we certainly regained that short visibility on that sell trade. And obviously the idea now is to get that short sell working for us. And what happened? Of course, the market got tanked at that stage. Big tank. But how do we know when we're crossing? How do we know when to step into those instead of waiting at the top edge? Well, that all depends upon the order flow, doesn't it? What else could have helped us with this as a storyline? Well, of course, whether volatility is in our favor or whether volatility is against us can help us quite dramatically. What was volatility doing at that stage? Was volatility peeling off that trade? If we look at all the various volatility metrics, was volatility starting to peel out from this trade? Well, we can see that it was quite clearly starting to peel out through that process. And obviously it led to this idea of getting that short sell for the press lower. So there's a lot of things that we can actually use to assist us with this decision-making process. There's a lot of structures involved in this as an idea. And obviously when we look at that as a trade, we think to ourselves, okay, but what was the RGL direction? We can see in the background that the RGL was predominantly red for the day. This was only the mock ignition trade, so this was why it went blue here. But it doesn't mean we can't resell it into that top line. The market overall shape is still sell side only business. And obviously the press into this closing bell here allows us to now see the closing bell itself as a new, what we call an RGL. It's buy side above, sell side below. In other words, if we come back to this as a process and I say to you, what is the best trade to be on? What is the best trade to be on? And you look at that chart. If you look at these longer term charts, if you start thinking about these as long-term swings, if I said to you, would it not be better to be selling when the market's red? What do you think? Would it not be better to sell when the market's red and buy when the market's blue? Well, of course it is. Well, if it's that obvious to everybody that you make more money if you short sold this sell phase here, more money if you short sold this sell phase here, and more money if you bought this buy phase, and more money if you bought this buy phase, then the decision isn't there for you. The decision is really about where do I buy, not do I buy. It's about where do I buy. If we continue to look backwards on the screen to make sure we're understanding this as a process, we can see there are several phases where the market goes a little bit sideways. We do have tools to accommodate this, but if we look at the red line as a key decider, you'll see there's a big thick red line running through this. This is basically just POC balance of the next price level, then of course, if I just draw that red line across my charts as it comes out, you'll be able to see that the selling actually came in exactly off that red line right there. And likewise, in the background, you'll see that red line there. You'll see that the selling came right off that red line as well. It's the big decider. It's the big deciding area. The red line there is the big deciding area. The red line here is the big deciding area. If the dealers decide to start marking up price above this, the market turns bullish. If they mark price down below this, the market stays bearish. So when we see the red line starting to sell off here, we know that that turns that market red, and we go short into that drive lower. You can see the red line here. The market stayed below it for almost the entirety. And obviously, as the market stayed below that price, we continue to project it across. And you can see that that sell contained the entire day's, even the rally phase, it still contained the rally phase move. So in other words, we start building out knowledge. We don't think of our market simply as a buy or sell side market on its own. The idea of adding the concept of the supply line, the idea of adding the concept of high volume candles. So when the market's red, if you want to fade the market, what kind of trade would you like to find? A high volume up candle, right? Why would you want to find a high volume up candle if the market's red? If the market's selling off, a high volume up candle suggests a what? A high volume up candle suggests an aggregated buyer. A buyer's getting aggregated. Some demand is getting bought. So with a high volume up candle in a red market, that's a good sign, is it not? So if I find blue candles in a red market, is that not a good sign? Well, the first blue candle in a red market kind of came in there, didn't it? The first blue candle in a red market came in there. Now, I'm not saying that that's your only trades, of course. The blue candle in a red market came in there, didn't it? And obviously, the short sale that came in following that was brutal. Brilliant little short sale. And then the next short sale that came in from here, brutal. And you can see that this next blue candle, sell side, the next blue candle, sell side, the next blue candle, sell side. So you can start to see that aggregated demand in a sell market is usually a great opportunity. This one didn't work out very well, but it still didn't lose any money. It would have scratched. And then this sell came in and it made some nice gains. So in other words, this is a part of the process, isn't it? We know what about high volume candles? We know that they are low volume nodes. We know low volume nodes are imbalances. In a sell market, that imbalance is probably bearish. So that imbalance is probably going to work sell side. Whether that demand holds, it's only going to hold when it drops through the bottom edge and retests the highs. We're still going to make money even if it's bullish. So when we see this as a storyline, and again, we're in a red side market again, and again, we can see aggregated demand coming in here, that's a nice opportunity to work short. It dropped from 44.03s to 44 evens. It's only 3 points, but it's still $150 with a stop at break even. And it doesn't mean we can't go back in again at higher prices. It doesn't mean anything of the sort. We can simply come back in again and say, we'll try it again. Let's try again. We're below the red line here. It's sell side only. I want to try it again. And we get big volume again here, which ultimately did read into that red side area trade for that short sell to develop. And obviously we move into this new aggregated demand here, which means I'm a little bit worried about this being a buy trade. It was a buy trade from this area. And obviously a buy trade coming back into this red zone again allows you an easy read at that stage there to buy back in at that point. And obviously that trade made okay money, good progress, 6 points, another $300. And then obviously this break, well, that's not a trade. This buy trade, of course, is back into that demand line, which starts off this new drive to the upside. Aggregated supply in a buy side market gives you a nice idea about buying still coming in here. And that gives you the idea of pressing into the top edge. A new RGL forms and we start the whole process again. Now we're obviously going through a lot of different things here because the point of this is to show you the depth of stuff we're going to be touching on. This isn't your usual learn one setup type classroom. It never is. We try and over-deliver a range of things that you want to pay attention to as a trader, as a dealer, as a market maker. We want to show you who's doing what and why they're doing it and how that's going to make a big difference to your trading. Now, if what you're looking at here is different from what you've seen before, if you've never been with us before, you'll start to recognize it's not about lagging indicators. It's not about buying and selling breakouts. It's not about that idea. It's about learning a lot of different moving pieces. We talk about learning a jigsaw puzzle. We talk about learning a jigsaw puzzle based on the idea that all the jigsaw puzzle pieces are in the box. Now, obviously, just emptying the box out and recognizing that it's a jigsaw is a great starting point, because at least if you know it's a jigsaw, you know the rules of jigsaw puzzles. You start with the four corner pieces. You then have the flat edges. You know the rules of engagement. Well, a lot of people start trading the markets and they don't even know the rules of engagement. They don't know who they're up against. They don't know what they're trading. They don't know what they're trying to look for. They are looking at a market and they're saying, I don't know what I'm looking for here. Obviously, when we start to apply this knowledge to this market, this aggregation could be buyers buying at higher prices, or sellers buying at lower prices, or buyers buying at higher prices, or sellers selling at higher prices. When we look at this against the idea of what the big boys are doing, now we get some ideas about whether it is buying at higher prices or selling at higher prices. Well, now this makes sense, doesn't it? This trade now makes perfect sense. We can now look at that volume there, and we're quite clear about what these two big volume down candles are, agreed? These two big volume down candles is some big commercial buying that discount price. Do you agree with that? Is that obvious now with the value going higher, the way the market values the market price, with the market value higher, that this must be a big commercial buyer coming in here on that red candle, a big commercial buyer coming in here on that candle. In other words, we're now getting the right trade at the right price, because that's different from this guy here, isn't it? There's no value to sell that short. So what is this guy doing here? Profit taking, right? They're trading into the prior level. So what is that volume there? What is that volume? It's simply profit taking. It's longs liquidating. Do you see the difference? We don't sell short that big volume. We simply sell to close off our longs. Massive difference in view, isn't it? Same volume narrative, different trade outcome. We start to recognize the different trade outcome. And obviously the idea here is if they are taking profits here, they will buy back when the price trades back down to trade into. They will buy back into those low volume nodes, and now you're now going in the direction of the RGL, the red-green zone. Well, it's really the red-blue zone, but it's obviously the big green board. So what is this guy doing here? What do you think that guy was doing there on that big volume? Simply buying. It's a big commercial buyer at that price. Well, do you not want to do business with these guys? Do you not want to be in the same side as these guys at that stage? Is that not a brilliant opportunity to buy? Just marvel for a second, guys. Marvel for a second at what you're actually doing here. That was the bottom tick of that swing. That was the bottom tick of that swing. That was the bottom tick of that swing. The last three buy trades you've just had have actually bottom ticked the entire moves. And you can't deny it. It's on the screens in front of you. You can't say, no, it didn't. It did. It's on the screen. And when the price trades up here, you'll see that the value is now dropping out. You've now got an opportunity potentially to top tick the price as well. You've now got an opportunity to start selling 4408s. Whether that you think the value is good enough to get short, I think it's okay to get short. I think certainly it's a closing trade for your longs, that's for sure. So whether you think it's good to get net short or whether it's just good enough to close your longs, you've just bottom ticked the buy price and top ticked the exit price. World class trading, not good retail trading, Ryan. Not good retail trading, world class professional trading. There's nobody else on the planet that could have bottom ticked that swing and top ticked the exit price. There's nobody else could beat that trade because there's no better trade. It's impossible. So when we think about what you've just accomplished on that trade there, you're simply looking at it going, oh my God, that's unbelievable. We've got the direction of the flow of traffic. The market's blue, so we would rather be buy side only. Berkshire's long, Vanguard's long, so I want to be buying with Berkshire and Vanguard. In fact, I can see Berkshire and Vanguard's buy opportunities. This buy trade here, this buy trade here, and this buy trade here. I can calculate some of my own buy opportunities outside of Vanguard. There was a little tester in here that there doesn't seem to be any real volume ones, but I could simply buy that little tester there, that little level 2 liquidity. So buying with the buyers, exiting when we see the profit-taking opportunities into these big block trades at the top edge, exiting, taking profits at these prices, buying, selling, buying, closing, buying, closing, possibly net selling there. And obviously what happens from that point is it now drives that line all the way through into this new change of direction. A new change of direction, and we start getting into that chart now proper. And as we zoom into this new change of direction, we can see just how the sell did develop into that storyline. There's a new town developing on the outskirts of the previous. It's got a whole different sheriff. It's got a whole different strategy. It's got a whole different game. We can see that there's no way I'm going to be buying the low price here or here or here or here. So in other words, I should be selling into those supply lines. I should be selling short into that supply. I want to be working that short sell. And that's what we learn through the BSG squeezes or the tipping price trades. As that short sell develops, we now see this guy coming in here. Now, I think at that stage, I don't think there's any doubt in my mind. With the red market in the background, I don't think I'm going to be worried about getting short there. I think that's a perfectly straightforward trade. As that short sell comes in, the value changes on me. And obviously at that stage, I'm going to say, you know what, I don't like it anymore. I'm going to scratch my trade at +1. Okay, was it a bad decision in hindsight? The price dropped, but was it a bad decision? No, I think it was a good decision. And when the trade trades back up again, trades into a higher price, and I start thinking about selling short in there, I don't think that's a bad decision. And when a trade retests here, I think the value still looks okay for the retest. I think it still looks as if I should be able to make money. So maybe I scratch it and then resell it again if I see the storyline. And obviously what happened to that short sale? Made some money. But now the value's busted. Now the value's gone off the trade. And obviously this is a cash close. We just close out our positions at that stage and say, cheers, mate, game, set, and match. Let's get away before the closing bell. Otherwise we start taking on margin. So when we think about these as trade strategies, and we look at things like value and volume at price, when we think about volatility hedgers, when we think about momentum players, when we think about the various actors taking place, we think about volume being a low volume node. And isn't it interesting that volume is a low volume node in hindsight? Now, you might not recognize that that's the case, but take a look at where we see volume coming into this screen. This is a 1-minute chart. Take a look at where volume appears. Just take any period. And what do you notice about where the volume actually does appear? Look, see how volume appears at that low price? Is that not a low volume node? Do you see that volume appears at that price? Is that not a low volume node? Do you see a volume appears at that price? Is that not a low volume node? Do you see volume appears at that breaking price there? Is that not a low volume node? Do you see volume appears at that price there? Is that not a low volume node? Do you see that volume appears at that price? Is that not a low volume node? Is that not significant? If simply you traded those low volume nodes, you're actually already improving your edges. Do you agree? You're already improving your edges. Because if I sold that low volume node without any other information, I could make money. If I sold that low volume node, I could make money. If I sold that low volume node, I could make money, right? So I could obviously look at that and say, well, low volume nodes in these areas, even on its own, can still make me money. You've already started to build an edge based simply on recognizing that low volume node is imbalance. Now, the problem you've got, of course, is when those low volume nodes don't reverse. Those low volume nodes are high volume spots. High volume spots are usually profit-taking spots. We've already established that when we looked at the market trader. In other words, if I'm looking to take profits on this short sell and the price breaks, I will put in a lot of buy orders here. And what does that cause? It causes a spike in volume. And because I'm looking at taking a lot of profits here, I'm putting in a big buy order. What happens is the market rallies simply because there's a big buy order there. It doesn't take away from the fact that there's a lot of sellers here as well. So that's neither bullish nor bearish, but what it does do is it still causes a market reaction. So more often than not, those volume spikes, whilst they might not turn the market round, they give us short-term respite for the sellers or buyers. They give us this idea that these volume spikes will nearly always at least pause the market temporarily. And we can then overlay things like relative value to figure out whether that buyer is indeed a net long, yeah, or whether that buyer is a net short, whether that buy candle here or that sell candle is a net short. And if it's obviously a big seller because the relative value is bearish, so we look at relative value like that and we say, well, I'm going to go short. I'm going to sell into the pullback and I'm going to go again. If the value is doing that, then of course this is net buying coming in by the big commercials. Surely if we don't know this, volume just doesn't mean anything to us. Surely volume is just volume. Well, not really, because volume is in its own right still an edge. The idea of selling to buyers or buying from sellers is a high-risk strategy. We're buying at low edges in this type of strategy, and we're selling at high edges in this type of strategy. So that's obviously going to add some risks. However, if we add an element of edge to those volumes, in other words, we add the directionality of the market based on the big board, we can actually improve that edge by trading in the direction of the big board with the same strategy. In other words, when the market's blue, I'm better taking these red buy candles rather than the blue sell candles as a rule. Because obviously if I do that as a rule, I wouldn't have bought any of these red candles. Because if I bought these red candles, this would have been the phase that I would have lost all my money using that volume strategy on its own. Do you see the difference? If we simply teach a volume strategy, the idea is that I could show you this chart here and you'd be going, oh my God, I'm going to buy volume and I'm selling volume, I'm selling volume. How much do you want for this indicator? It's worth a fortune because I don't show you what happened to the left-hand side. If we followed the same set of rules, you would have been buying, of course, here and you would have lost money. You'd have bought here and you might have made some money or scratched. You might have bought here, you might have made some money or scratched. You would have bought here and lost money. You'd have bought here and lost money, and you'd have bought here and lost money, and you'd say, oh my God, that trade strategy is rubbish. Trade strategy is rubbish. I can't make any money based on that storyline. So you've got to do better than volume, haven't you? You've got to do better than volume. It's obviously incredibly important, but it's not the single most important ingredient. That volume means that there are sellers at lower prices. And what we've tried to encourage people to understand is, whilst this is definitely an area where we take profits and we always take profits, the idea is if we've got selling is to do the exact opposite to buying into volume. Selling back to volume. So in other words, we should be selling back to the volume here. We should be selling back to the volume. We should be selling back to the volume, right? And do you see what if we sell back to the volume when it goes above the volume node? Do you see we make money? And then when we see this volume here and then it turns into buy volume, do you see what we could be doing? We're buying back to the volume. Do you see how we can still make money? And we're doing away with the risk associated with this trade. We're doing away with an awful lot of the risks. So we should be selling back to that sell volume. We should be selling back to that sell volume. We can do better than that, of course. We can obviously understand that we can do better, but when the volume turns, so do we. So when the volume buyers come in here, we buy back towards the volume. When the volume buyers come back in here, we buy back towards that volume. When the sellers come in here, we start thinking about top edges. We start thinking about selling back to that volume. We start positioning ourselves for the short sell. When the buyers come back in, we buy back towards the volumes. We can still play safe. We can still play safe. So instead of trading the flip on the volume, we can trade back to the volume, which means that when the market trends, we're not beaten by the problem that the turtles had. We join the flow. We join the flow of the marketplace. We join the flow of the marketplace and we sell back to volume. Do you see what happens when we sell back to volume? We generally, as a rule, make money. And when the volume comes in on the buy side, we stop selling. And we start buying back to the volume. We start buying back to the volumes. And when the volume seller comes back in, we start selling back to the volumes. Selling back to the volumes. And when the buying volume comes back in, we start buying back to the volumes. Buying back to the volumes, buying back to the volumes, buying back to the volumes. And we are now pressing our edges, pressing our edges, pressing our edges. And you see how we can trade the choppy market and we can trade the sideways markets. We're not held captive the same way as the turtles were held captive. We're not simply trend traders. We can trade this with a bracket. We can trade these brackets. This was a bracket trade area, didn't go anywhere, and yet we were simply never caught on the wrong side of the bracket, were we? We were never caught on the wrong side. And obviously when the selling comes in, we change our ideas. We start selling back to the volume. We start selling back to the supply. We start selling back to the supply, selling back to the supply. And what else do we do with this trade? We add ideas. We add relative value to the idea. We start looking for the relative value storyline to improve our positioning. So that instead of being captive to this idea, we simply then look at this buy trade. We're buying back towards volumes here. We're buying back towards volumes and then selling comes in. What are we doing? We're selling back towards volume. And look at what happens to that sell trade. Is that not incredible? So in other words, it doesn't matter whether the market brackets or whether the market trends, we're still doing the right things at the right times. We can overlay this with value. We can overlay this with order flow, something we'll do obviously in classroom. But the key core idea is to know what the big board's doing, what the volumes are doing, and what the price is doing, and what the relative value is doing. If relative value is bearish in a big board bullish market, we have to make some concessions to that trade. If the relative value is bullish and the big board's bullish and they're selling, we simply buy from it and we get a lot of money on board. When we think about the market in terms of those narratives, the idea of selling back to volume in a red market, we're left with the possibility of still working these orders in line with the value that's evolving. The idea we should be selling short when the buyers are coming in, acknowledging the buyers are coming in, perhaps getting a little bit more aggressive in the way that we buy off the bottom edges. But we never buy top edges in a red market, do we? We never buy top edges in a red market because that's a bad deal. We sell top edges in a red market. We can still potentially buy bottom edges in a red market so long as there's buyers above us here, here, and here. That's the bottom of the market. So I can buy the bottom edge of the market there, and I can make a great decision at the right time. Recognizing this idea allows us not only to trade from the outside in, Greg, but also from the inside out, because we can also trade the trend. Because if you think about it, this phase here, was this from the inside out? Was this trade here from the inside out? Yes, right? So we can trade from the inside out here. We can trade from the inside out here. We can trade from the inside out here. But when that volume comes in, we're now trading from the outside back in. So we can change our strategy. We can change our tact at the right time based not on some lagging indicator, not on some divergence on a stochastic, but we can change our tact based on market-derived real-time information, recognizing buyers at higher prices, recognizing that somebody's willing to pay across a spread and understanding why they would do that, then recognizing whether that fits in with the overall view that the market's now developing and giving us a trade idea to buy the bottom edge. That's what we're going to learn for the next 5 days or the next 4 days. We're going to learn how to process this information more accurately, more timely, and to trade with us. If you don't join us for the next 4 days, of course, the one thing that I hope you take away from this is to try and trade with the flow. However you define that flow, try and trade with the flow back towards volume. If you learn nothing more, you could still trade this using moving average crossovers. If you've got volume candles at a bottom edge and you've got a moving average that's dropping, sell back towards that volume. And if you do nothing other than that trade, you will be a lot more successful as a trader going forward. So that's the one key takeaway from this trade here. Drive the volume, drive the trade back to that volume node because you're selling back to sellers at lower prices. The seller doesn't disappear. They are there, they are visible, they are on your screens. That seller is now there. So we use order flow to find that trade as well. When we start thinking about that short sell or that buy trade opportunity, we simply use order flow. We use the concept. Some people don't like the phraseology of trapped traders. I don't quite know what's wrong with trapped traders. Take a look at these two trades. The guys in the room will recognize what's happening in these two trades almost immediately. I've always said to people we should always trade against trapped traders. There's a retail guy that sells courses, and he's actually okay. Can't remember his name. But he talks about there's no such thing as trapped traders. Of course there is. There's no such thing as a guy that's trapped permanently. Of course there's not. But there are trapped traders. We can see them on the charts all the time. So to say there's no such thing is just ridiculous. So one of the things we recognize, and it's just in terminology, guys, there's a trapped seller here, which opened the door to this brilliant buy trade. You can see there's a trapped seller because the blue line is lower than the price, significantly. The blue line is higher than the price here, significantly. So what should we be doing up here? Selling. The blue line is massively higher than the price here. So what should we be doing here? Selling. So is there no such thing as trapped traders? Bollocks. These sellers at the bottom edge were trapped. And because the sellers at the bottom edge are trapped, I want to be long. The buyers at the top edge are trapped. And because the buyers at the top edge are trapped, I want to be short. If I had a long trade setting up there, I would not take the trade. I don't want to join the end of a big long queue. If you join the end of a big long queue, guys, you will end up getting the rubbish at the end of it. You only want to trade in the direction. You only want to trade in the direction of the quiet spaces. The quiet spaces, those wide open prairies where nobody else roams. That means that you're obviously early to the party. You might argue that you might be at the wrong party entirely. Well, that's okay because we've got other tools that can tell us what party to be at. But obviously, when we start to relay that information onto our charts, we can start to ask the question, what party should I be in these areas? Have I got the right party? Have I got the right storyline? Have I got the right narrative? Have I got the right idea about what I'm supposed to be doing here? Well, if we look at this idea of this buyer over here, look at the time, 2030, right? 2030 approximately. Well, what party should we be at, guys? What party should we be at? There's a lot of buyers in this party here. Do you think those buyers are right when you look at the value in that trade? Do you think in the right-hand edge, the hard right-hand edge of that chart, when you draw a straight line through this price area here, and at the same time you look at that price area, drawing that straight line through that price area, and you look at what we call relative value, and the relative value is doing that, do you not look at that and say to yourself, these buyers are really, really badly exposed? That's a good thing, right? There's a lot of doofuses here. There's an awful lot of doofuses trapped on this buy trade, and they're on the wrong trade, and there's lots of them. Do you not want to sell when there's lots of buyers that are on the wrong trade? Do you not want to be the guy that sells? Because you're going to make a lot of money when they puke. When they throw away that buy position and they throw away those trades. Is that not the trade you want to demand to be on? Of course it is. Of course it is. That's exactly the trade I want to be on. So when we see this trapped seller, when we looked at that seller and we said there's a lot of sellers down here and they're trapped, was there a reason why they were trapped? Look at the value, guys. Was there a reason that they were trapped in here? Was there a reason that they were trapped? Of course there is. They're on the wrong fucking trade. They're on the wrong trade, aren't they? So when we see those sellers getting trapped and we know that they are in the wrong trade and they're at the wrong door, their throwaway positions are going to make me my money today. So when I tie those trapped sellers, the levels, the volume, and the value going bullish, if I can tie those pieces of the jigsaw together, I will make money. I might still have to do a bit of work. I might still have to put in a few times, a few bids, trying to capture these guys. But my goodness, if I have confidence in my process, and this process has been built over 40 years of being in the market space, but if I've got confidence in my process and you'll develop that confidence, the challenge you've got is turning that into real money. If you see a very busy queue of people and they're all shouting, sell, sell, and they're all jumping for joy and the sale's not going anywhere, and you're looking at them saying, these guys are cannon fodder. The more sellers, the more I like it. But I guess what kind of trade we're going to do, guys? We are not going to do a buy limit order to their selling. Because if we do a buy limit order to their selling, are they trapped? Yes or no? If I do a buy limit order to their selling, are these sellers trapped? Yes or no? No, because the price hasn't stuck them yet, has it? If I sell at 50 and the current price is 49, am I trapped? If I'm selling at 50 and the current price is 48, am I trapped? No, because I can take a 1 tick or a 2 tick profit on the deal. If the seller comes in at 50 and the price is trading 51, am I trapped? I'm trapped. I'm jammed on a trade that I can't make any money on. If the seller comes in at 48s, even more sellers come in at 48s, and the trade's trading 52s, am I trapped? Sure. And if I'm trapped, am I on a bad trade? Absolutely. If I'm on a bad trade, am I more likely to throw my hand in? Absolutely. Is the price more likely to pull away to the upside? Absolutely. Because there's no fecking value for those sellers. So when I tie in the value of sellers, and I tie in the trapped sellers, and you tie those two pieces of the jigsaw together, you find trade perfection from the big boards. Too many sellers on the right trade is bad enough, right? Too many sellers on the right trade is bad enough because it's still a busy trade. Even if they're right, they'll still probably get pushed around a little bit. But too many sellers on the wrong trade is like gold dust. And that there is too many sellers on the wrong trade. That there is too many sellers on the wrong trade. I want to annihilate those guys. And if I find that one trade set up a day, that trade was at 19:30 tonight. It topped out at 19:40, guys. Topped out at 19:40, 19:45. It was about 15 minutes long. 15 minutes long. It went from 75 to 85 for a $500 winner per contract in 15 minutes. If that's my only trade today, I should be delighted with that trade outcome. I should be absolutely ecstatic with that bit of business. So in other words, tying the jigsaw puzzle pieces. Now, this is what I'm saying. You know what a jigsaw puzzle does. You know how it works. You know how it's going to evolve. Do you realize if you turned up in this room half an hour early, I told you that trade. I suggested that trade if you turned up half an hour early. There was a couple of people in half an hour early. I don't know if anybody was listening to me at the time, but there was a few people in half an hour early, and I was actually already starting to discuss that bottom edge buy trade when I walked in the door. And as I walked in the door, I was starting to see that setup developing. And I started to say to everybody that was listening, there's maybe an opportunity here to sweep this price lower into what's the mock ignition trade open. And if we run the stops at the bottom edge, that's going to be a constructive, I use the word a constructive bottom line. I like the buy trade, in other words. And that buy trade was worth $500 to anybody that was in the room, simply from the very first trade that we gave a live trade call on. The very first trade, $500 potential profit. Not a bad little outcome for turning up half an hour early. As they say, the early bird catches the slug, or whatever it is. So it's a great trade to start with. It's a great trade to see live that developed there. There's no fear about it. If it doesn't, it's a probability, isn't it? The probability was we were going to make money. We just have to act on that probability over and over again to make the probabilities count. It's about probabilities. It's not about certainties. There's no certainty that this is going to be the buy trade, but there's a certainty that if everything else doesn't change, this will be a winning trade for us. We've got the right conditions. The buyers are in the right position. The sellers are trapped. The value's got the sellers trapped. They don't even know about it yet. They're going to find out soon enough. The market maker's going to pull away their offers. These buyers are going to think, what the hell happened? And they're going to puke their positions, and that's where we make our money. Do you want to learn where these places are? Do you want to get a good grasp of these areas? If you do, join us for the next 4 days. And obviously, we'll go through this in a lot more detail as it goes. I'm going to finish off with that. I'm going to let Kim wrap this up, and then we'll get started in this proper. And tomorrow, we'll start driving into some of these lines, some of these areas, some of these thoughts. And obviously, we'll be looking at the charts on the right-hand edge as it develops over the course of the 8 o'clock to 9 o'clock session, of course. And we'll carry forward into the closing bell each day, I'm going to say thanks very much for turning up. I know it's always a big challenge to get people to spend some time with us guys in the retail space. A lot of people look at it and say, well, it's a lot of hard work and it's not the easy button. It's not really for me. That's absolutely fine. We've obviously shown you some stuff from our oil, from our gold, from our wheats, trades from crack spreads, from a lot of different angles. The point is, there's a lot of ways to trade. There isn't one way to trade. There's a lot of ways to trade, but they're all involving a little bit of work. But then it's not about me calling the trades. It's about you seeing the trades for yourself. You deciding that this is the way you want to trade. You want to be a professional, not a retail. You want to have the knowledge about how to trade properly in the right way, whether you decide to trade momentum-based trades or fade-type trades or a combination of both. At least you've got the tools, the right tools, not a set of lagging indicators that simply just give you bollocks. At the wrong time, at the wrong price, trading the wrong price areas and the wrong value areas. Decide to step up and do the right thing. Decide to trade the way the professionals trade and see how you get on for a change. It's only going to be for 4 nights. And obviously, after that, you can figure out whether it's the right way to learn for the rest of the marketplace. Learning about interest rate curves, learning about supply and demand on oil, learning about the dots plots, learning about all of these fundamental elements, learning about oil inventories, learning about the bond auctions, and all the things that go with professional trading, all packaged into one source. So it's not an order flow class. It's not a fundamental class. It's not a price action class. It's not an indicator class. It's a trading class. The only one of its kind where you're learning the proper way that the pros have learned for decades. And that's what you're trying to understand about the marketplace, is how to be a professional trading the right things at the right prices. Have a good one, guys. If you decide to join us, I'll see you guys tomorrow night for the first full session where we start to dive down into each of these elements. Have a good one. I'll leave you with Kim. I'm out of here. I'm going to say adios, amigos. Arrivederci, auf Wiedersehen, sayonara, tutsins, taxka do dos vidania, and spasibo, guys, in the meantime. Ciao for now.
Thank you so much, Ray. What a start to this week. That was fantastic. Thank you, Ray. You always bring the goods. And guys, as Ray was saying, and I had told you guys earlier, I'm going to give you guys all the details for those of you that aren't with us on a daily basis. If you want to join us, in fact, real quick, I'm going to go ahead and put this we have another slide there that I can show you. And then there you go. I think everyone can see that now. Can you guys see this slide? Anyway, I just want to let you know that we do have a special. We are going to be having a 3-day scalping class that kicks off tomorrow. I should call it a 4-day because it's Tuesday, Wednesday with Ray, then Thursdays with David and possibly Greg with our order flow tools and our different resources that we have. If Greg's able to join us, he'll be showing some stuff on TradingView. We've got David, and we have our tools on Sierra Charts and Ninja. So I think we have the absolute best there. So Thursday will be a technical session. Then we'll wrap the week up with Ray on Friday. All sessions will be at 3 o'clock, and all sessions will be recorded. So you can always, you know, reach out if you have any questions, but I'm going to definitely answer questions here. We're so thankful to have you guys in. We haven't done a session for so long. And as always, Ray, way over delivered and brought you guys some great gems, different way to look at the market. I always say, Ray provides the why. So let's dig into that so that we can answer your questions, make sure that everyone can get signed up to spend the rest of the week with us, because it's going to be good. I'm going to go ahead and stop the recording here so I can answer questions, because I think at this point we have a pretty long recording already. That way Serge will be able to get it taken care of.